I start my class with IFRS 15. That is revenue. IFRS 15 is revenue. So usually I start with my class with IFRS 15 revenue. Revenue from contracts with customer. Okay. So my first question. I always ask a lot of questions. What do you all understand by the word revenue?
Income that the business earns.
Income that the... Okay, perfect. That's amazing. Okay. I'll draw two diagrams. You understand subsets, sets and subsets, 11, 12th match. I'll draw two diagrams. Both of you tell me which one is correct. Okay. So that's how I start usually. Tell me if A is correct or B is correct.
A is correct.
A is correct? Okay. What do you think, Amit sir? Which one's correct? A is correct or B is correct? Which one do you think is correct? A is correct. Yes, absolutely correct. Income is a broader concept. Income can have anything like, what do we say? Rental income, dividend income, interest income, etc., etc. But revenue is a narrower concept. Revenue will have only and only income that comes from the operations. So IFRS 15 is one of the lengthiest chapters of or one of the biggest standards of your SBR curriculum. So we prepare a mind map. Ma'am, what are we going to learn? What are the things that we are going to learn? So first, any chapter will have an introduction. My handwriting, my spelling, my maths, all of this is bad. Only thing that I'm really good with, that I'm confident about, is my accounting. Other than that, please forgive me. Mathematics, very bad. Handwriting, very bad. Spellings, very bad. Second, we are going to learn, in introduction, we are going to learn 5 steps. Do you remember 5 steps? I mean, a little bit of idea that IFRS 15 had 5 steps of revenue recognition. By any chance, do you remember? Yeah, you remember. Yeah, there were 5 steps. Okay, at least we remember that. What was there in that, we don't remember. That's okay. So we'll talk about what are the 5 steps. Then in second part, like I'll prepare the mind map, and I would request you all also to prepare this mind map. So you know, whenever you start your studying, ma'am, where can we get these notes from? Just give me your number. I'll share it to you. If there is a weekend batch already, group is there, or what? WhatsApp group? I don't know. Yes. So you can share it with the people. I think 2 of you are only there. So you can share it with your friends. Okay. So second, we are going to learn step number 1. That is identify. I'll write. Right now I'm just writing. Then anyways, we'll have a discussion, a detailed discussion. Today, whole day. Tomorrow, first half will go only in revenue. So that much time we need for revenue. Very intense, very detailed sessions we are going to have. So step 1, identify the contract. Then we are going to learn step number 2. In detail, we are going to learn. In step number 2, it's nothing but identify PO. PO means what? Performance obligation. You can write down, Amit sir and Abdul sir, you can just make a note of this, then we'll start. Okay. Identify performance obligations. Fourth one will be we'll learn in detail, step number 3, that is your determine transaction price. TP stands for transaction price. Okay. Now fifth will be your step number 4, allocation of revenue in separate PO. PO is nothing but performance obligation. Then we'll learn step number 5 in detail, that is recognize revenue. Okay. Then we'll have some special cases. Your case number 1 is sale with right to return. Then we'll have some principal versus agent accounting. Then you will have consignment arrangement. Consignment arrangement. Then we will have warranties. How do you account for a warranty? Then we'll have repurchase agreements. These are some special cases that we are going to study. After that, we are going to study contract asset. What is a contract asset? How do you account for a contract asset? Basically, here we are going to learn capitalization of contract costs. We're going to learn capitalization of contract cost. And the ninth part, we're going to learn nothing but contract modification. So when you master all the 9 topics, then and only then you will be ready for any exam kit question. So you'll have to master these 9 topics very beautifully. Okay. Now, when I talk about identify a contract, I always start my class with a mind map so that we know these are all the things that we are going to learn. Here, guys, there will be 5 conditions. There will be 5 conditions. You should remember the 5 conditions. Your answer should have, if there's a question on identification of a contract, there should be 5 conditions. What is the meaning of contract and how IFRS 15 will be applicable. When I talk about identify performance obligation, there will be 2 conditions. There are 2 conditions that says when your performance obligation is separate. We'll learn everything in detail. We're going to go to the depth of the chapter and learn. In determination of my transaction price, we will have to master. I'll just drag it a little bit over here. If you have space, you all can do it alongside. There are 4 things that you will have to master. First thing is your variable consideration. Second that you have to master over here is significant financing component. Third thing that you all have to master over here is non-cash consideration. Okay. And the fourth thing that you have to master over here is consideration payable to the customer. I'll write it properly. Consideration payable to customer. Is it readable, sir? A little bit?
Yeah.
Last point. Yeah. These are the 4 points in step number 3 we will have to master. These are the 4 points that we'll have to master. Cool. I'll just erase it. Should I erase it? Okay. Now these are 4 things. Now allocation of revenue in separate PO, just one thing that you have to see, it is in the ratio of SSP. Recognize revenue, again, 2 things at point in time. Make 2 arrows and say, right, at point in time. Revenue can be recognized at a point in time and revenue can be recognized over a period of time. Okay, cool with this? The 4th step. Now special cases are special cases that will, anyways, there are no special conditions. These are all special cases that we'll have to learn. Now this repurchase agreement, I would just want to highlight one part. Here we'll learn 3 types of repurchase agreements. One is forward, the other one is call, and next is put. In repurchase agreements, you'll have to learn 3, not 4 types of agreements, that is call, put, and forward. In principal versus agent, there are 3 indicators. 3 indicators of principal. There are 3 indicators of principal. So this is a whole mind map. This is how one day before exam, when I see the mind map, I should know each one of the thing. When I say 3 indicators, it should be on the tip of my tongue. When I say 5 conditions of a contract, it should be on the tip of my tongue. If that's how your clarity is, if that's how your conceptual clarity is, nowhere rank is gone. You can also score rank. So don't worry whether my financial reporting is good. Ma'am, I'll only rate myself 5 or even 2, 1. Doesn't matter. We are starting from a fresh slate, fresh beginning, new beginning. We'll learn as if we are learning it for the first time only. So just try to, communicate with me. That's when I know. If you won't tell me, I would not know whether we have understood or not. Okay. So this is the whole, the map of your chapter or the standard in one page. So this will help you a lot in revising. So shall we start with our chapter? Please take my number. I'll just pause the recording and send me a prepare using BPP and some of the Kaplan material also. It's basically a combination of both. From the academy, you will be getting access to BPP material. They'll reach out. The team will reach out to you how you can purchase BPP material. Okay. So we start with our IFRS 15 revenue from contracts with customer. So first thing that we need to understand over here, this standard is only applicable to contracts with customer. Only customers. So for example, we take example of ArivuPro Academy. ArivuPro Academy has some contract with you. You guys have entered into a contract with ArivuPro. ArivuPro Academy has some contract with me as well. I have also entered. We have an agreement. Tell me, is it applicable to me? This standard accounting is it applicable to me? Tell me, Amit sir, is it applicable? Is the standard applicable to the contract that ArivuPro Academy has with me? We do have a contract. There is a proper contract, documented, written and signed. But the answer is no. But the contract between you and ArivuPro Academy, this standard is applicable. So we'll learn how the fees that you pay to us, how do we account how do we account that fees? So my dear friends, this is a weekend batch to here. IFRS 15 has simplified or put the revenue recognition process into 5 steps model. There are 5 steps. When you fulfill all those 5 steps, then and only then you can recognize revenue. It means what? Prior to that, can we recognize revenue? The answer is no. So a company, an entity should fulfill those 5 steps to recognize revenue. Now, my dear friends, I'll just tell you one thing. See, when you're meeting me for the weekday batch, usually students meet me only for 4 hours. But we will be here for 6 hours. So there might be a possibility that after a point of time, you will get tired. Like, ma'am, there will be too much of information. So please come with that mindset that the session is going to be heavy because we have a very less time to cover a lot of things. So what I cover in 3 days, we'll have to cover in 1 day. Are you getting me? So just try to keep yourself fresh. We'll get enough breaks. Don't worry. If you all are tired, we'll take enough breaks. But we'll try to study as much as possible. So just make yourself strong for that part. Okay. The sessions are going to be really intense and very heavy also. At times you might feel tired. After 5, you'll be like, ma'am, no capacity to study, nothing, no information. But we cannot, skip that part because we have a very less time. You are appearing for September. You plan to. Amit sir, what is your plan? September or December? Okay. So there are 5 steps chartered. I usually address my friends as chartered only. You are anyways going to be chartered certified accountants. So step number 1 is identify the contract. It means what? There has to be a contract. I will take your example and ArivuPro Academy's example. You came here, you got yourself registered for a weekend batch. Tell me, do we have a contract? Yes. I mean, there might not be a written contract where you signed and academy signed, but we do have a contract. We committed that we'll provide you with coaching. You committed that you will pay the fees that we agreed upon. So first step is identify the contract. Now here, the contract, guys, can be written. It means signed by both the parties, proper documented form. It can also be verbal. I am planning for December attempt. Okay, you're planning for December attempt. That's good. So either it can be written or verbal. Verbal, ma'am, how? Do you go to a restaurant? Do you like going to restaurant by any chance? Yeah. So I'll explain. Let's say I went to a restaurant. There's a restaurant near here only, California Burrito. I go there and I order for let's say a burrito bowl. Okay. Now, tell me, if I don't pay and I step out of the restaurant, what step restaurant can take against me?
They can ask you.
They can ask me to pay. If I don't pay, still they can force me to pay. Yes. Can they force me? Yes. Why? There's no contract. Nowhere I signed, nowhere California Burrito signed that Surbhi will have to pay for this. But still there is a contract, right? When I said one bowl of burrito bowl, one bowl burrito rice and whatever, there is a contract. So standard says yes, there is a verbal contract. Verbal contract is also a contract. Now another example. Third, your contract can also be implied. Implied means what? So, sir, do you have a friend? Do you have friends? Let's imagine you have 2-3 friends and you all go to one place where you like what person are you? It's a tea person or a coffee person? Tea person. Me too. Tea. Love it. So let's say you have a place where you like tea and you go with your friends, and the shopkeeper knows you and your friend so well. He knows Abdul sir will ask for this tea only. Let's say a masala tea if you like. So whenever you go there, even before you guys ordering, he will give you masala tea. So that is also a contract. If you don't pay, the shopkeeper can force you to pay. So as per IFRS 15, it's not like the contract to apply IFRS 15, the contract has to be written. The contract can also be verbal. The contract can also be implied. So that's the first criteria. So when you entered over here, we didn't have a formal documentation, right? You did not sign a contract with ArivuPro Academy. Like there was no legal document. But you do have some acknowledgement receipt that you have taken admission for this. Tomorrow, if you don't pay the fees, can we take legal action against you? The answer is yes. Tomorrow, if next Sunday onwards or if next Saturday onwards, I don't come, we withdraw the batch. Can you take a legal action against me? The answer is yes. Are you getting me? So if tomorrow I don't show up, I say, okay, I don't want to teach you. So can you take any action against me? The academy says we are closing the ACCA completely. Can you all take the action against? Yes. So that's what a contract. So IFRS 15 is applicable to all the types of contracts. Okay, ma'am. So we understood the contract can be legal. You're not legal. Legal is always said written, verbal, and even implied. So that's our step number 1. Step number 2, identify the contract. Now there are 5 conditions that I'll teach you all going forward. So what are the types of contract? Can I say written, verbal, and even implied? Implied means what? By actions. By actions, if you imply something, it is also a contract. Step number 2. Step 2 is nothing but identify. Identify separate performance obligations. Identify separate performance obligations. Now this is a new word, ma'am. What is the meaning of performance obligations? The performance obligation is nothing but the promises. In layman's language, if I say, it is nothing but a promise. Did I make you a promise? Yes, I made a promise that will complete whole of the SBR. What is your promise to me? To pay the fees. Yes or no? So here, understand, charters. The promises, identification of a promise will be from the seller's perspective. Who is a service provider over here? Me. ArivuPro Academy is a service provider. So from service provider's point of view, you will have to identify what are the separate promises that me as a service provider or a goods provider has made to the customer. So let's say I promised you when you entered here, let's say for the admissions, I'll play a role of a salesperson. I say, sir, you will get a weekend batch coaching. Weekend batch, there will be a SBR coaching. Then you will also get notes, handwritten notes or whatever, the notes from the faculty. You will get a BPP material. So you will get access to mock test. You will get access to recorded classes also. If you miss by any chance or you're sick, you cannot come to the academy, you can access the recorded classes also. Yes or no? These are the promises that we made. So as a seller, I will have to identify what are the promises I made to you. So let's say I'll keep it simple for us for right now. I said I made a promise that I will give you my notes that I prepare, and also I will give you an access to you will get a classes. So what are the two promises? Lectures and notes. So here these are my two promises and performance obligations. Are we cool with this? Yes. Yes, Amit sir, are we okay with this? Any difficulty you can please ask me, okay? Step number 3 is nothing but determination. Determine the transaction price. Determine, whatever pronunciation you like to say, determination of transaction price. And what do you mean by determination of transaction price? Firstly, what is a transaction price? The price agreed upon between you and ArivuPro Academy. So for example, let's say the SBR fees is 10,000 rupees. Okay, so SBR fees is, I'll use dollar sign because a lot of our, not all, a lot, most of the questions will be in dollars only. So let's say the fees is 10,000 rupees. But Abdul sir, you are one of our old students. We gave you a discount of 2,000 rupees. So how much you had to pay, sir? 8,000? Yes. Now my question to you is, sir, tell me, the transaction price is 10,000 or 8,000? Just a rough guess. I mean, I don't expect you to be correct, but a rough guess. Amit sir, this question is for you also. The fees was 10,000. We gave you a discount of 2,000 and you ultimately had to pay only 8,000. So as per you, what, guess. I'm not asking any technical question, just a guess. Our transaction price is 10,000 or 8,000? 10,000. Okay, Amit sir, Abdul sir says 10,000. What do you say, Amit sir? 8,000. The correct answer is 8,000. Okay, perfect. Why 8,000, ma'am? Why not 10,000? Because this is what I'm getting, right? I'm not getting 10,000 from you. I am getting how much? 8,000 from you. So the price agreed upon, that's what I said, you know, the price agreed upon between you and ArivuPro Academy is the transaction price. So we'll learn, don't worry. So here there are 4 things. There can be a financing component in the transaction price. There can be a variable consideration. There can be a consideration payable to the customer and non-cash consideration. All of these we are going to learn. Now step number 4. Step number 4 is nothing but allocation. It's basically a mixture of step number 2 and step number 3. What is our step number 2? Determination of, identification of a performance obligation. Third is determination of transaction price. So when you merge both the when you merge both the steps, you get 4th step, that is allocation of transaction price. Allocation of transaction price to separate performance obligations. So step number 4 is allocation. Ma'am, how are we going to allocate? We are going to allocate this in a ratio. Here we'll have to find out a ratio. Ma'am, all 11th and 12th ratio that we did, the answer is no. Here the ratio is very simple. In the ratio of SSP. SSP stands for nothing but standalone selling price. So this anyways, when we come to the step number 4, we will learn. So, and the step number 5. Step number 5 is nothing but recognize revenue. It's recognize revenue. Okay. Now we take an example. Okay, a little bit of brief overview of the chapter I would like to give you all. Now we take an example. Let's say Abdul sir and this is Surbhi. Okay. Now sir, you came to the academy and you said, madam, I want to learn SBR. So we signed up and we said, okay, sir, we have a weekday batch, we have a weekend batch. You signed up for the weekend batch. Now, so can I say there is a contract? Identify, step number 1, identify a contract. It is a verbal contract. Now step number 2, identify performance obligation. I said, sir, I will give you, you will get the access to my coaching, the lectures, and you will also get an access to the notes that I prepare. So what are the 2 promises that I made to you, sir? Can I say? Notes and lectures. Are we okay with this part? So these two are what my separate performance obligations. Are we all okay? Here in step number 3, we determine what? Transaction price. So the transaction price, what happens, sir? Okay. Transaction price is what? Let's say 8,000 rupees. So here the standard says in step number 4, allocate the transaction price to separate PO. So tell me, what are our PO, sir, in this case? Notes and lectures. Now tell me, you came here on the day 1, we gave you a book, a compile or a printout of a book. Can I say this promise is done right away at this point of time only? Yes. So this is called performance obligation. It's just giving you a technical word. Don't worry, you will get everything, you will learn everything. So this is called performance obligation satisfied at a point in time. At a point in time means what? When I fulfill my promise right away. When I fulfill my promise right away, the performance obligation is said to be satisfied at a point in time, right away. So if I give you my notes, I said, sir, take these notes. These are the notes that you have to use for the rest of your 2 months or 1 month that you are with me. So this is called at a point in time. At a point in time. Don't write. It's just an example. Don't write anything. We'll learn this in detail. Okay. Now tell me, lectures can I give you right away? Like, can I just say, sir, when I am done within 1 hour, can I teach complete SBR? The answer is no. It will take some period of time. So in this case, can I say my promise or my performance obligation will be satisfied over a period of time? So here, this performance obligation will be satisfied over a period of time. So let's say individually on website, if you go, if I sell my notes right now, I've not started selling, but let's say if I sell my notes individually or my books, I charge 2,000 rupees, and for lectures I charge 8,000 rupees, not 80,000, 8,000. Okay, so tell me now, individually if I sell, how much will I charge? 2,000. Individually if I sell lectures, how much will I charge? 8,000. So this 2,000, this 8,000 is nothing but stand-alone selling price. It means what? Alone if you sell them. Stand-alone means individually if you sell them, how much are you going to charge? So can I say, if I individually sell them, a person would have to pay 10,000 rupees. But how much did you pay, sir? In our example, 8,000, right? So this 8,000, I received only 8,000, but individual prices are 10,000. Sum total of individual prices are what? 10,000. So I will have to allocate this 8,000 in this ratio. So let me show you how we allocate. So what are my PO? Can I say notes? And the other one is lectures. So 8,000 is my transaction price. You will multiply it with the standalone selling price. Individual standalone selling price divided by total standalone selling price. Likewise, you will do the same thing for this also. Divide by 10,000. This is nothing but, this is called in the ratio of SSP. We just found out a ratio, right? This is nothing but ratio of SSP. Can you help me with the two numbers, sir, over here? 8,000 into 2 by 10 and 8,000 into 8 by 10. Help me with the number, no? Amit sir and Fayaz sir. Fayaz, right? That's how we pronounce, no?
1,600.
First one is 1,600. That should be 7,400 if I'm not wrong. No, 6,400. Yes, 6,400. Okay, understood. So this we did what? Allocation part. We have come to the step number 4. Now, ma'am, tell me. Today, when I entered the class, let's say 20th of June, when you signed up for the class, I gave you my notes. I gave you all the notes. Okay, so can I say this performance obligation is satisfied right away? So this promise is done. So when the performance obligation is satisfied, the standard says, IFRS 15 says, please recognize revenue. Surbhi, you can recognize revenue. So can I say today, in the month of June, I will recognize revenue of notes fully because I have fulfilled my promise. Whether you have paid me or not, that's a secondary thing. The payment is not the triggering point. The triggering point of IFRS 16 is the performance obligation. If I have fulfilled what I promised to you, IFRS 15 says, please credit your P&L. Now, tell me, this lectures, can I say this will go on for 2 months? I mean, 1 month, in 1 day, I cannot complete it. So standard says spread it over the 2 months time. So 6,400 revenue will be recognized in 2 months. So tell me, in 1 month, how much revenue will be recognized? 3,200. So lectures revenue in the month of June will be how much? 3,200. So what is the total revenue I will recognize in this month? Can I say 4,800? Are we all okay with this part? So in the month of July, when I take you all to the month of July, what will be my revenue recognition notes? No revenue. Performance obligation done. Here it will be 3,200. 3,200. If you combine them, the total comes to 8,000. So this 8,000 transaction price will be spread over this. So this is called at a point in time. This is called over a period of time.
I could not understand the previous.
Which one?
We calculated, right?
Yeah.
What step? Could you repeat that step?
Yes. So what are my individual selling price of this? 2,000. What is my individual selling price of lectures? 8,000. So what is the ratio? If I purchase 2 individually, can I say 2,000 by 10? Like this is a ratio. If I purchase a total, a person purchases, let's say, notes, a person purchases lectures also. Can I say in total he'll have to pay how much? 10,000. So what is the proportion of notes to the total price? Can I say 2,000 by 10,000? Proportion we are finding out basically. What is the proportion here? Can I say 8,000 by 10,000? Yes. Now I paid how much, sir? Only 8,000. So I have to divide, or I have to spread it into this bifurcation. So let's say 8,000. If I okay, let's say if I have to simplify it, can I say notes form 20% of my total transaction price? Not transaction price, total money that I'm going to receive. Can I say this forms 80% part?
Yes.
So this 8,000, 20%, if you put for notes, how much it will be? 80% if you put for notes, how much it will be? So again, 1,600 and 6,400. That's what. Yes. So that's nothing but the bifurcating into the ratios. Okay, the ratio of standalone selling price. Yes, sir. Amit sir, are we good? Are we okay? So these are basically the 5 steps. Tell me, any difficulty, any doubts, any point that you all did not understand? We started at 1:30, right? Can you show me the, yeah. If you want to note down these steps, you can. We'll study till 3, then we take a break of 30-45 minutes. Yeah, you're okay with like 3 hours of 1 hour 30 minutes of at a stretch? No worries. If you're tired, just let me know. In between, if you need 5-10 minutes break, we can do that. The plan is 1:30 to 3 at a stretch. Then we take a break till 3:30. And then 3:30 to 7:30. However you all like, you all can decide the course of the class. I mean, if you feel, ma'am, we need this much of break or whatever, you just tell me. I'm audible, right? I need not use mic. Should I? No, he can hear me. He has this for you.
Yeah.
Good. Good to go, Amit sir. Good to go. Yes. Okay. So what did we learn? I mean, this anyways will take a little later. Some definitions are there. Contract, liability, performance obligations, done. Okay. So we were discussing this 5-step model. So I'll read my notes so that notes don't feel, a little bit unfriendly to you. It should not feel, I don't want you all to get used to what I write. I want you all to understand this also. Okay. So we started off with 5-step approach. What is the step number 1? Identify the contract with customer. So contract means what? An agreement between a teacher or an institute and a student. So I just, whatever example I took over here, That's the example I've written over here. So what will the agreement state? It will say that, sir, the course will run for two months. You will be taught SBR duration and the fees. For example, a 3-month taxation course coaching, the duration is 3 months and fees is this. So student agrees to pay and you agree to teach. There is an agreement. It is a contract. Second is what? Step number 2, identify performance obligation. Now, whose perspective you have to look from? Seller, service provider. So performance obligation are the services you promise to provide, the promises that I made to the student. So for example, the coaching program includes weekly classes, study material, doubt solving sessions. These are the performance obligations. Each of this is a promise to the student. So these are my separate performance obligation. Step number 3 is a transaction price. So it is a total amount that you expect to receive. It's not the fees. I mean, it's not the, the base fees, but rather what you actually expect to receive. For example, the taxation course fees is 30,000. So if I expect to receive 30,000, this is my transaction fee price. In step number 4 is allocate the price to the obligation. So what is my transaction fee, sir? 30,000. What are my promises? Classes, study material and doubt solving sessions. So let's say this is my individual price, individual selling price, 20,000, 25,000, 5,000, 5,000. So this 30,000 will be recognized. 20,000 will go to your this, 5,000 will go to this, 5,000 will go to this. This is called allocation. I'll tell you, I mean, this is just a basic example. We'll go forward. As we go forward, there will be a ratio. Now, recognize revenue when the services are delivered. So, when you actually provide the service, not just when the money is received. So, for example, student pays 30,000 on the day one itself for a 3-month course, but you will teach for 3 months. So, you will spread this over the 3 months period. Are we good with this part? Okay. So, now, I want you all to try this question. Try this question. This is a question from your book only, one of the books. Okay. On 1st December, first you give me a random, scribbling only. I don't want you all to solve. Just give me your suggestion. On 1st December 2001, Wade receives an order from the customer for computer as well as 12-month technical support. Wade delivers the computer and transfers the legal title. It means what? The control has been transferred. Control means you have actually received it. My promise is done. To the customer on the same date. Can I say the computer was delivered on the 1st December 2001 itself? What are the two promises in this contract? If you see, we will provide computer and we will also provide 12 months of tech support. So can I say the two promises are made by Wade to the customer? Sir, I will give you a computer. I will also give you a 12 month of tech support. So can I say computer? I will fulfill my promise right away. You came to me. I said, sir, take the computer. My job is done. But this 12 month will go on for 12 months. Can I complete 12 month support in one day? No, right? So this will go on for 12 months. Okay. So this is what at a point in time. This is over a period of time. Perfect. Amazing. So Wade delivers a computer on the same date. It means what? Wade has fulfilled one of its two promises. Customer paid 420 upfront. So it means what? It is a transaction price. If sold individually, selling price of computer is how much? 300 and tech support is what? 120. So can I say if sold individually means what? It is a stand-alone selling price. You are required apply 5-stage revenue recognition as per IFRS 15 and determine how much of the revenue should be recognized for the year ended 31st December 2001. Try. You speak Tamil, sir? Amit, sir, you speak Tamil? Yes, or any other language, sir? Which language do you speak, sir? Should try. Try and tell me how much revenue should be recognized. It's very simple, but a little bit. I just want to see how well do you understand this. Amazing. That's good. What do you think, Amit, sir? Okay. So see, 300. Now I bifurcate my. Yes. Can you explain the sum again? Yes, sir. Yes, sir. Sir, I am Wade and you are a customer. Imagine you are my customer. Now, sir, tell me, I received an order from a customer to supply a computer and a 12-month of tech support. So my question to you, sir, tell me, what are the promises? What are the different performance obligations of Wade to the customer? Tell me. You'll have to communicate with me, sir. Tell me, what are the promises made by Wade to its customer? What are the promises made by Wade to its customer? Why would you rate yourself 5? You're doing good. You should have rated yourself like much. Okay. Technical support and a computer, sir. A computer and a tech support. Are we okay with this part, sir? There are 2 promises made by Wade to its customer. Yes, sir. Will you agree? So can I say separate POs? Is what? Computer and tech support. Now, sir, what is my total transaction price? What is my total transaction price? $420. $420. So in step number 3, we determine our transaction price. Okay. So step number 1, we assume there is a contract. Performance, I started from step number 2 only. Separate PO, that is your computer and a tech support. So step number 3, what is your transaction price? Can I say $420? Now step 4, allocate in what? Allocate your transaction price in separate PO. Yes, sir. So what are my separate PO, sir? Computer and tech support. So what is my SSP of your tech support and computer? If you read the question, it says if sold individually, computer you will have to pay $300, and for tech support you will have to pay how much? $120. So 300 and 120, the total comes to 420. Yes, sir. Are you okay with this? Yes. Now allocate 420 in this ratio. Now 420. How will I allocate it? 420 into 300 divided by 420. 420 gets cancelled. Computer will be how much? 300 only. For tech support also, if I do 420 into 120 divided by 420, that's how we allocate. Yes or no? So can I say this and this will get cancelled? The price to be allocated to computer is how much? 300, sir. Price to be allocated to tech support is how much? 120. Okay. Yes. Allocation part, are we okay? Or want me to again? Are you okay with this allocation part? Yes. Amit, sir. So see, my transaction price is what? 420. And the sum total of my individual SSP is also 420. So ultimately, the price to be allocated to computer is 300. Price to be allocated to tech support is 120. Now see, computer I can provide right away, sir. Right away. You come to me, I'll give you the computer. But tech support will go on for 12 months, sir. So computer 300. Can I say I gave you computer today itself? 1st of December when you came to the class, I gave you the computer? Yes. So can I say I fulfilled my this promise? I completed my this promise? Yes. But tech support, I will have to provide you for next 12 months. Can I recognize this revenue right away? The answer is no, because this will go on for next 12 months. What is the fees for this? 120. Now this 120 will be spread over 12 months. So how much revenue will be recognized in 1 month's time? Can I say, sir? $10. $10. So what will be my December month revenue? See, you read the question. 1st December and you're required to tell the revenue for 31st of December. Can I say 1 month revenue? In 1 month, can I say 300 will be fully recognized? But from tech support, only 10 rupees will be, not 10 rupees, $10 will be recognized. So can I say 300 for computer and tech support 12, $310 is the revenue to be recognized in the month of December. Aidacha. Yes, that's how you say, right? Done. Aidacha. I'm learning Tamil actually. I don't know Tamil. Yes, sir. Okay. Because this job is done, only 1 month of tech support is done out of 12 months. So I will recognize only 1 month of revenue. Yes, sir. Yes, sir. Okay. So when you read the solution, sir, Identify the contract. I'll read the solution for you all. So agreement, there is an agreement between Wade for provision of goods and services. Separate performance obligation, can I say computer and a tech support is my separate performance obligation. Transaction price, what is my transaction price? 420. Allocate it, so can I say standalone selling price is 300 and for this is tech support is how much? 120. So that will be the same, ratio is same, so the same price will be allocated. Now recognize revenue as and when the performance obligation is satisfied. So can I say computer has been passed to the computer, so full revenue can be recognized, full 300 can be recognized right away, but tech support will be provided over a period of time, so revenue has to be allocated for 12 months. So in the month of December, how much of the revenue will be recognized? Only $10. So 300 plus $10 will be my revenue for the month of this December. Are we okay? Yes, charted. Good to go. Or not okay? Okay. Now we go to the very, very interesting step. Identify the contract with customer. Now, what do you mean by a contract? First, before applying IFRS 15, we will have to check whether there is a valid contract or not. So contract means an agreement between two or more parties that creates rights and responsibilities. So what are your rights, sir, in our contract between ArivuPro Academy? What is your right?
Access to classes.
You can demand classes. If tomorrow Surbhi doesn't come, Surbhi doesn't show up, you can make ArivuPro Academy get this promise fulfilled. If not Surbhi, make somebody else, but make us complete SBR. Yes. What is my right, sir?
You should provide the
Right. Not obligation. Right. What is my right? If can I demand payment? If tomorrow you don't pay the fees, can I demand the payment from you? Yes. What is my obligation? To provide coaching. What is your obligation? To pay the fees. So there are some rights, there are some responsibilities. Responsibilities are nothing but obligation. So IFRS 15 asks, when does a valid contract exist? A contract exists only and only when all of the 5 conditions are met. Ma'am, all the conditions should meet together. The answer is yes. All these 5 conditions should be satisfied to say that there is a contract. Ma'am, okay. Please explain us the 5 conditions. The very first condition is both the parties have approved the contract. It means what? When you come to the academy, you say, I want to learn SBR, and I say, we want to teach SBR. So both the parties, you say, okay, I'm signing up for the weekend batch. I say, okay, I will also teach you on the weekends. So you should have also approved. I should have also approved. Both the parties have approved. Very simple condition. So it can be, I told you all, it can be a written also, it can be an oral also, and it can be a normal business practice implied contract also. Second condition is each party's rights are clear. Rights are clear means what? You know what are your rights. I know what are my rights. I know I can demand payment. You know you can demand the coaching. Okay. So customer has a right to receive the laptop. Seller has a right to receive the payment. Step number 3, payment terms are clear. Payment terms are clear means what? You know, okay, if the duration is 2 months, how are you going to pay? Let's say the transaction fee is 10,000. 1 month you will pay 5,000, that other month 5,000. So payment terms are clear. It means what? Contract must clearly state how and when the payment will be made. Next, 4th and 5th condition are a 5-star condition. Only the first 3 conditions were like very kiddish condition, like very kiddish condition. Okay, 4th condition is contract has commercial substance. It means what? The contract must change company's future cash flows. Okay, now to explain this to you all, I will take an example. Let's say, sir, which phone do you use by any chance? Can you help me with the model?
Honor 20.
Sorry? Corner.
HO.
Honor. It's which brand, sir?
Wow.
Ayo, I don't know. How do I not?
Just use some random.
You choose some random phone. Okay. So, sir, okay. Hamid, sir, can I get your, I don't even know to pronounce the name of the, yeah. Sir, can you give me your phone details, please? Personal information, sir. I'll ask you slowly and gradually. I'll take all the personal information from you all. I think. Don't worry, don't worry. It is nothing that is not available in public domain. I will not take. Okay, so sir has nothing CMF 2 Pro. Sir, if I may ask you, when did you buy this phone, sir? When did you purchase this phone? Can you give me like exact timing, like 2 years back, 1 year back? When did you purchase this phone, sir? Nine months back. Okay, so sir purchased this phone when 9 months back. Now imagine, I want to teach you a commercial substance. Imagine this phone is also what? Nothing CMF 2 Pro. I also purchased this phone 9 months back. So I and Amit sir, we enter into a contract to exchange this phone. Same phone. If today I go to the market and I sell sir's phone, I will get how much? 10,000 rupees. If I sell my phone, I will also get 10,000 rupees. Now tell me. Now, will it make any change? Will it make any change to my future cash flows if I sell my phone or sir's phone? No, right? No, because I sell my phone in the market, I will get how much? 9,000 rupees. If I sell sir's phone, how much will I get? 9,000 or 9,000, 10,000, whatever is the amount I said. So it means what? It will not change my future cash flows. It is a mere exchange of a similar good or service. For example, sir, you also teach SBR, I also teach SBR. I said, sir, I will teach you IFRS 15, you also teach me IFRS 15. It is a mere exchange of same services, mere exchange of similar or same goods or services. So here, because of this, my future cash flows won't change. My future cash flows won't change. Let me change the example. Let's say sir has nothing CMF 2 Pro. I have an iPhone. Now, when I exchange this, my future cash flows will change. I purchased this 2 years back. So, if I sell my phone today in the market, I will get how much? 6,000 rupees. But if I sell sir's phone in the market, I will get 9,000 rupees. Can I say now my future cash flows will change? It will make a difference if I sell my phone or sir's phone. Yes. So in this case, the contract in the second example, when it is a exchange of different type of goods or services, there is a commercial substance. It means the future cash flows are going to change. But in the exchange of similar or same goods and services, when the future cash flows won't change, you say the contract lacks commercial substance. Are we okay with this part? Now, ma'am, why would a company enter into this? Why this, condition was introduced? A lot of times, what companies used to do, they used to exchange similar goods and services, and they used to say that it is a revenue. It is a revenue. We have recognized some revenue, but in reality, they never really made money out of it. In reality, they never really made money. So here the standard makers understood that such transactions are happening a lot. People are just, if I want to overstate my revenue, I will enter into a contract with Amit sir, let's do this. We have a written valid contract. We can prove it. If auditor comes tomorrow, we can prove it that there is a contract. But the contract does not have commercial substance. It is just to overstate my revenue. It's just to show my P&L very beautiful. Oh my God, I've made a lot of income. Which is why the standard setters came up with the provision that if the commercial substance is not there, no matter how valid the contract is, we will not let you enter into your P&L. Do not recognize. So commercial substance means it is a really, it is going to change your future cash flows. You're really going to make money or lose money out of it. It doesn't matter whether you're going to make money or lose, but your future cash flows will change. It means you're not just exchanging the same or similar goods or services, which is why the fourth condition, there has to be a commercial substance. It means what? The contract must actually change the company's future cash flows. It can also increase or decrease. It doesn't matter. In simple word, it should have a real financial impact. If I exchange a phone worth rupees 9,000 with a phone worth rupees 9,000, it won't have any real financial impact. So it means what? A consulting firm signed 5 lakh for an advisory contract. It will increase the future cash flows. The commercial substance exists. Are we good with this part? Very good condition. Very good. If you tomorrow you appear for an interview and they ask you 5-step model, if by any chance they ask you, you should know this. Yes, sir. Amit, sir. Are we okay with this part? Is this condition okay to us, sir? Tell me. Tell me. Yes. Now the last condition, nothing but your collection is probable. Payment collection is probable means what? On day one, sir. On day one itself, when I'm entering into a contract with you, I should know that you're going to pay. I should know that you're going to pay me. Here, sir, we are going to check 2 things, sir. We are going to check 2 things. Ability and intention. Ability and intention. Ma'am, what do you mean by ability? It means what? I'll not take your example. I'll take, let's say we have another example, Mr. Amit. Amit is there. Oh, sorry, not Amit. We take another example. We have another student in the name of, let's say, give me a name, a random name. Rakesh. We have another student in the name of Rakesh. Now see, understand, if on the day one, when I'm entering into the contract, I see Rakesh does not have ability to pay me. Ability to pay means what? He's not financially sound. He doesn't come from a financially sound background. It means what? I will not recognize the contract. I will not recognize that IFRS 15 will not be applicable. Second is intention. Intention means what? He should have a willingness to pay me. So if you watch in movies, you see a lot of political parties, they you will see those gundas. They go to the shop, they purchase something, but they don't pay. You see, you would have encountered such in real life also, you would have encountered, and in movies also you would have encountered such situations. So here it means what? I do have ability, but I don't have an intention to pay you. So to apply your IFRS 15, the customer should have ability. It means what? He should be financially sound and should also have an intention to pay. Intention to pay means he should, even though he's financially sound, but he should have. Do you understand Hindi? No, little. Okay, so we'll not get into Hindi. He should have that willingness to pay. Are we okay with this part? Okay. So I'll put you here. I'll draw a little bit of, we'll go a little level up, will go. So sir, what is the date today, sir? 20th of June. Let's see, here we come to 21st of August. Some random dates I'm taking. So on 20th of June, Rakesh, the another imaginary student sitting right beside you. I can see him, but you can't see him. Just imaginary don't get scared, okay? Just a joke. So you're not scared. If I were you, I would have been like, yo, is there any ghost? So 20th of June, Rakesh, my imaginary student, sitting right in front of me. Hi, Rakesh. Now, he had ability. He also had intention. Okay, he was financially sound. He had a job, a very good, capable to pay me. So, I recognized revenue. Let's say I'm done teaching on 20th of June only. 20th of June. I'm done teaching and everything is done. I recognized revenue. So, can I say IFRS 15 was applicable? When provided all the conditions are fulfilled. Can I say 20th of June, IFRS 15 was applicable because the day when we entered into the contract, Rakesh was all cool, all financially sound. But as the time passed, when I demanded the payment, later what happened? Rakesh went bankrupt. Rakesh could not pay me. Rakesh lost his job. So here on 21st of August, when this had, ma'am, what do? You recognized revenue. Now the customer does not have intention. The customer does not have capability to pay. So if anything happens, the ability or the intention fails after inception of the contract, then IFRS 9 will come into picture. Because my Rakesh is what? A debtor in my books. So if anything happens to debtor after entering into the contract, then IFRS 9 will come into picture. Here we will learn ECL, expected credit losses. Don't worry, if you didn't understand, that is also fine. But I just wanted to, one of the students asked me this doubt. Ma'am, what if he loses his job after entering into the contract? If he loses his job after entering into the contract, he'll become my debtor. And debtor, if anything happens to my debtor will be taken care by IFRS 9. Are we good with this part? Okay. Amit sir, are we good? Cool, sir. Any doubt? Any difficulty? Okay, so what are the 5 conditions? It should be on the tip of my tongue, sir. By the time you go home, you should know all the 5 conditions. What is the first condition, sir? The contract is approved. So what is the keyword? Approved. Approved by the parties. Second condition, rights are clear. Your rights and my rights are clear. Third, payment terms are clear. Fourth, there is a commercial substance. And fifth, the collection is probable. Collection is probable means what? Ability and intention. I am using exactly those words that you will have to use in your exam. You will have to write a case study, right? Nothing is objective. None of your question is objective. You will have to write. So when you write, your answer should have these keywords. First, okay. So if we close our eyes and if we try, okay, don't look at the screen. We try to see how much we remember about the 5 conditions. What is the first condition, sir? The contract is approved by both the parties. Second, rights are clear. Rights, your rights are clear, my rights are clear. Third, payment terms are clear. Fourth, commercial substance. Fifth, payment collection is probable. Easy. We don't have to mug up. So if I take you to the mind map, we are done with this part. We're done with this part and 5 conditions also. Good. Yes. So this is how I'll take you how we revise. So introduction, we know 5 steps. We know identify the contract, 5 conditions. Are we good? Okay. Okay. Now I want to level up a little bit. Shall we? You want to write something?
Yeah, like
Oh, okay. Yeah, please make a note of these 5 conditions. Well, please note down these 5 conditions. I'll just refill my water bottle and come, okay? Aidicha. I'm learning Tamil. So far, I've been able to learn how many, Tamil theriyadu. First thing that I learned. Then, inge perana. You don't laugh, huh? Second, I learned inge va, unge pa, sapadiya. And I'm here. I've been here for a week now. I came last Sunday, so I learned one more sentence because I love idli dosa a lot. So I say, unna dosa anna, and randa coffee. Teach me Tamil. That's I'll tell you why. Because my mother, like I say this to everyone, my mother grew up in Tamil Nadu, so
she knows.
yeah, she knows Tamil, but we never communicated in Tamil because our mother tongue is different. So only she knows. In my whole family, only she knows Tamil.
You're Hindi, right?
Yes. I am from Rajasthan, Marwari, if you know Marwari. Yeah. Done, sir. Everybody. Amit, sir, we good? Now I want to twist whatever I taught you all. I want to do a little bit of undo of it. There are some exceptions. Sir, can we go forward? Do you want to say, Amit sir, do I have your approval? 1 minute? Okay, 1 minute. Okay, sorry. Take your time. You must be how old?
Turning 24 next month.
Oh.
What about you?
I'm 28.
We say Akka.
Akka. I know Akka. And what do you call it? Tambi. Younger sister. Brother is Tambi. And what do you call
Sister.
younger sister?
Tangachi.
Tangachi. Okay. Nice. Teach me Tamil. I love this. I want to, by the time I go back to Bangalore, I want to be very fluent in Tamil. But in my academy, a lot of people, Koramangala. So a lot of people are from Karnataka itself, and other than Karnataka, a lot of crowd is from Kerala. So the languages that are commonly spoken in the academy is Malayalam and Kannada. So I'm also learning Kannada also. Good to go. Now, what did we learn? So far good. Like, are we understanding? Yes. So far, what did we learn, chartered? What did I tell you? You do not recognize revenue. IFRS 15 is not applicable if these 5 conditions do not meet. Yes. But the standard says we twist a bit. There is a little bit twist. Standard says Surbhi, first thing is, if these 5 conditions do not meet, please, no revenue. But ma'am, what if we receive some payment? What if we receive some payment? Let's say, sir, you made a payment of 5,000 rupees. So can I say debit bank? A little bit of journal entries will be required, okay? Not little bit, a lot of journal entries. So I hope your journals are good. If not, if our basic journal entries are good, we are smooth. Fine, SBR will go very smoothly. Are you, who's calling me now? Okay, so debit bank, can I say debit bank will be there? Debit what comes in? So 5,000 is what I will debit. Are we okay with this part? Now, credit goes where, ma'am? Credit goes where? Let's say the contract is not approved. You came here, you said, I'm paying it, you approved, let's see if you approved the contract. I mean, let's say the academy said we'll have to figure it out if we have a weekend batch or not. We'll just let you know in a while. But you said, sir, I'm making a payment, you confirm. So here, the contract is not approved by either of the party. Let's say it's not approved by the academy. So can I say one of the 5 conditions has not met? IFRS 15 is not applicable. So how? If ArivuPro Academy has to account for on day 1, where will the corresponding credit go? If it were, let's say a normal 11th, 12th accounting, I would have done what? Debit bank, credit, revenue. Yes or no? But here, revenue will not come into picture. Why? Because ma'am, 5 conditions did not meet. IFRS 15 never ever will come into picture, ma'am. So the standard says here, the corresponding credit will go to a beautiful name, a new name, to contract liability. To contract liability. Till the time all the 5 conditions are met, you park this money into a separate account in the name of contract liability. Okay, ma'am. Let's say later on the conditions met. And we satisfied our performance obligation. Surbhi is done teaching also. So standard says now what you initially credited contract liability, you debit contract liability. So can I say it will get cancelled out? We know it will get cancelled out. So no more contract liability in my balance sheet. And the credit now you can transfer it to revenue. Are we okay with this part? Yes, sir. Amit sir, we good. So the standard says 5 conditions met. Please. No, there's a twist. Don't write. I'll make you write. Don't worry, we'll write. So the standard says, because there's more to this part. So the standard says 5 conditions do not meet. No, Surbhi. No, don't recognize revenue. IFRS 15 is not applicable. Okay, ma'am. Understood. Ma'am, what if we received some money, but still the 5 conditions did not meet? The standard says, okay, even if you have received some money, do not take it to revenue. We will not allow you to go to P&L right now. Park it to some different account in the name of contract liability. Till the time all the conditions meet, till the time you satisfy your performance obligation, you park it in a separate account in the name of contract liability. When all the conditions meet, when your performance obligation is also satisfied, you will reverse this and you will credit revenue. Are we okay with this part? Amit sir, we good? You can just give me a thumbs up. I will be okay with this. Okay, but now here there is a twist. The standard says, Surbhi, we give you one flexibility. That instead of going to contract liability, Surbhi, you can go to revenue. Surbhi, you can still go to revenue. I ask, sir, my 5 conditions are not met. Yes, still you can credit revenue. Only in either of these 2 situations. So there are 2 situations where you need not park your money to contract liability, where you can go to revenue when if situation 1 and there is a situation 2. Situation 1 says no remaining performance obligation. Plus the money non-refundable money. So it means what? Let's say, sir, do you go to concerts or some, events and all? Sir, Amit sir, do you go to any concerts and events? Any favorite artist that you like to go? Yes, even you go. So tell me your favorite artist. Both of you tell me your favorite artists. Anirudh is a singer. Sir, your favorite artist? Any? Anirudh. Oh, coincidentally, both have same this. So let's say there's an event of Anirudh on 25th of June. You went to book my show. You purchased a ticket of 1,000 rupees per person. You paid 1,000 rupees. And as per the terms of the contract on book my show, this is a non-refundable. Whether you attend or you don't attend, you will not get the money back. It is a non-refundable. Usually the shows have non-refundable, right? There's a duration after which you cannot cancel it. So let's say this is a non-refundable fees. So now when I talk about Anirudh, let's say there's a company, Anirudh would be running some organization. I mean, there would be some company form of organization. They have received money. Yes. Has the condition fulfilled? No. Let's say either of the condition did not meet. You did not approve, or there is no commercial substance. Either of this did not meet. So standard says if there is no remaining performance obligation, but what you have received is non-refundable. Plus. You have received substantially all of the consideration. All of the consideration. In this case, sir, if these three situations meet together, whatever money you received, even though any of the condition did not meet, please do not go to contract liability. You can credit revenue. Okay, ma'am. Second condition is contract is terminated. Terminated means what, ma'am? Cancelled. Either you cancel or the seller cancel. Plus fees or money that you received is non-refundable. Okay, you need not write. I'll give you time to write. So, ma'am, again, long story short. Standard says 5 conditions. Step number 5 conditions. If all of these 5 conditions meet, then and only then IFRS 15 is applicable. Okay, ma'am, understood. So, ma'am, if these conditions do if these conditions do not meet, but we did receive some money, okay, no worries, park it into a separate account in the name of contract liability. Okay, ma'am. Now, there are 2 exceptions to this accounting treatment. The standard says either of these two situations, you need not go to contract liability. You can you can go to revenue. You can directly recognize income when, in situation number 1, you have received some money and there is no remaining performance obligation. Second, the money is non-refundable. Third, the money that you receive is substantially all of your consideration. Substantially all of your consideration means what? The transaction price was 1,000. I have received 900 rupees. Substantially all of the money has been received. 100 rupees, let it be. So substantially all of the money has been received. Then please don't go. Then please don't park it into contract liability. Please recognize revenue freely. Ma'am, 5 conditions didn't meet. Yes, still recognize revenue. Okay. Second situation, either the contract is terminated, either by sir or me, and the money is non-refundable. Sir says, Surbhi, I don't want to learn from you. No worries, sir. Here, the money is non-refundable. Surbhi can still recognize revenue. Are we good with this part? Okay. Sir, we good? Amit, sir, we good? I'll read this. We'll have a lot of revision. Trust me, by the time you go home, this will be on the tip of your tongue. That's my promise to you. You will be like, okay, we remember all of this. So, what happens, sir, when these conditions are not met? IFRS 15 cannot be applicable. If these conditions are not met, you don't apply this. So, company must keep reassessing the criteria until the criteria is met. The day criteria meets, reverse the contract liability, recognize revenue. But ma'am, if money is received but contract criteria are not met, you paid something, but ArivuPro Academy did not approve the contract. So in this case, if you receive the money before confirming the contract criteria, the amount should be recorded as a liability, not as a revenue. So for example, a company pays to 20,000, a customer pays 20,000 in advance to book a training program, but the company has not yet confirmed the contract. So accounting treatment is advance from customer is a liability. So ma'am, what are we going to do? Debit bank, credit contract liability. Okay ma'am, okay, 20,000. No revenue yet. You do not recognize the revenue. Okay ma'am. But there is an exception. We can recognize revenue even if the criteria are not met. What is the situation 1? No remaining obligation. Substantially all of the consideration is received. plus consideration is non-refundable. So substantially all means at least good amount, at least 80-90% of the revenue has been received. Okay. So for example, a company charges 1,000 non-refundable registration fees for a seminar. Even if the person does not attend later, the fees is kept, the revenue can be recognized. Even if the criteria are not met. Let's say there is no collectivity, not collectability. We'll go with commercial substances not there. Or let's say payment terms are not identified yet. Any of these conditions are not met, you can still recognize revenue. Situation 2 is what? Contract is terminated. Contract is terminated means what? The contract is cancelled. So contract ends, the customer can get a refund. So, slip of tongue, customer cannot get refund. So a consulting firm receives 50,000 in advance. Later, client cancels the contract and the fees is non-refundable. The company can still recognize the revenue. So under IFRS 15 does not specify the contract must be terminated by either seller or the buyer specifically. The key point is over here, the contract has been terminated and the agreement between both the parties no longer exists. Okay. Are we all okay? So what is the second condition? The contract is terminated and the consideration is non-refundable. If both are true, the amount received can be recognized as revenue. Okay. We're good with this part? Okay. So would you like to try one question on your own? Or only on these 5 conditions? The 5 conditions that we mastered, only on these 5 conditions, there is a question. So I'll read the question for you all, but the first level of try will be from your end. I will come after you all are done trying your level best. Okay, shall we? Okay, I'll read the question. I'll highlight the important parts. Jute is a major property developer. 1st June 2003, it entered into a contract with Myntra to sale of a building for 3 million. Can I say 3 million is what my transaction price? Who is my seller? Jute. Jute is a property developer. It entered into a contract with Myntra. Myntra is what? Buyer. Jute is a seller. Okay. Yes. Now, Myntra, can I say buyer, paid a non-refundable deposit of 1,50,000. 3 million is how much, sir? 30 lakhs. 1 million is 10 lakh. 3 million is 30 lakhs. So, if I write in lakhs, can I say total transaction price that I wish to receive is how much? 30 lakhs. Out of 30 lakhs, Myntra has paid me 1 lakh of deposit. Okay. On 1st June 2003. Now, 1,50,000 is how much of 30 lakhs? Can I say 5%? 3 5s are 15. So 1,50,000 is nothing but this is 5% of my total consideration. Now, on 1st June 2003 and entered into a long-term financing agreement with Jute for remaining 95% of the promised consideration. So remaining consideration for Jute, it entered into a financing arrangement. Financing arrangement means what? A kind of a loan. The terms of financing arrangement are that if the buyer defaults, Jute can repossess the building. It means what? Let's say you are a buyer, I am a seller. Our contract is to sell the building. So I sold the building to you. What is the transaction price? 30 lakh. On day 1, you paid me 1,50,000. Remaining, you will pay later. So remaining, if you do not pay the money, I can repossess the building from you. I can take the building back, but I cannot demand further consideration, but cannot seek further compensation. Even if collateral means what? Any asset that you have pledged is collateral does not cover the full amount owed. So even if, let's say, you pledged a house, imagine here there is a further condition. Let's say you imagine you put this your phone as a collateral. If I cannot recover my money even after selling your phone, I cannot ask any money from you. Maximum I can do is take my building back. Okay. The building cost Jute how much? 1.8 million to construct. Myntra obtained the control of a building on 1st June 2003. It means what? The control has been transferred means what? My performance obligation is done. I am seller, you are buyer. So if I gave you the control, my promise is done. Munro intends to use this building as a fitness center. It means what? You intend to use this building as a gym, fitness center. The building is located in a city where there is a competition in fitness industry is very high. So let's say, what is a very popular area of Chennai? Like a commercial area where there are a lot of gyms and all of those clubs and Nungabakam. So let's say you want to start a gym in Nungabakam only. And here there are a lot of gyms. So can I say it will be a hard time for you to start a gym? I mean, if there are already well-established gyms over here, people will take time to come to you. And many successful fitness centers already exist. Okay. Munro, your experience in to date has been in stores selling health foods and has no experience of a fitness industry. So far you have been selling, you know, those fitness bars and all, protein bars and all. You don't have experience in running a gym. Munro's health food stores are all pledged as a collateral in a long-term financing arrangement, and health food business has seen decline in profit over the last 2 years. Even your health food business is declining. You're not making money in that also. Munro intends primarily to use income generated by fitness center to repay the loan from Jute. Now your intention is to repay my money is by running the gym, and whatever money you make from the gym, you will pay me. You are required whether Jute can apply revenue recognition model of IFRS 15 to the contract with Munro. Explain the accounting treatment of 1,50,000 that you received on 1st June 2003. You understood the question? Yes, sir, you understood the question? Tell me, sir. Yes, everybody? Yes, okay. Take 5 minutes. Think. Just think. If it is your SBR paper only. Day one, we prepare ourselves with that intention that if it is my real paper and if this is a case study, how am I going to approach? Whatever we studied in last 10 minutes, all of this will be used. I'll keep quiet for 5 minutes. Try. Once you're done, just tell me. Sir, once you're done, send your message. Just scribble and tell me what is your answer. Once you're done, you can just have a discussion with me. 5 conditions only. First 5 conditions. We can recognize it as revenue. Think about it. I would still say think about it. The answer is incorrect. We cannot recognize revenue. So I want you to go back and check one of the conditions. Okay, let me give you a hint. One of the 5 conditions is failing. Okay, we are not meeting one of those 5 conditions. And if it is failing, we know we cannot recognize revenue. We can recognize if either of the 2 conditions meet. 2 situations meet either of this. So check now. Which condition is failing? Check.
Looking at the contract conditions or the revenue recognition.
The 5 steps. The first 5 condition of step number 1, 5 condition approved, payment terms. So the commercial substance and all. So one of those 5 conditions is failing over here. Okay, the contract is indicating that one of the conditions is not meeting. And if that condition is not meeting, it means IFRS first step is only failing. IFRS 15 first step is only failing. Now think which condition is not meeting.
Collection of payment.
Yes, got this. So we know that payment collection is not probable. Sir, you understood? Okay, let me discuss this question with you. We recognize revenue with the contract, ma'am. Payment, yes, payment terms are clear, sir. Payment terms are clear, but collectability is not probable, sir. Payment terms are clear. He will pay. Anyways, 3 million. We know 3 million is what you have to pay by making money. Whatever money he is going to make out of the sale of the gym income, that he'll have to pay. But sir, understand here understand what it is trying to say. Munro, the buyer does not have experience in the gym, so we are not sure. Even though he might have intention, but he does not have ability to pay. Are you getting me? He's not doing financially sound. His other business is failing, and he is running. He is going to start a gym. Let's say, sir, you gave me a money of 1 lakh. Now you see, I don't have a job. When you gave me the money loan of 30 lakhs, I don't have a job. Whatever job I am doing, I'm failing in that also. So what you will feel? My money is gone. Are you getting me? So if you were Jute and I were a Munro, what you would feel on day one? I have given her a loan, but still, firstly, she doesn't have experience in fitness industry. Second, her this food business, the health food business is also failing. So you are dicey. You will be dicey whether I will receive my money or back or not. Are you okay with this part? So here, the fifth condition, that payment collectability is not probable. So ma'am, we understood one of the 5 condition has not met. So can I say this 1,50,000 we received can be recognized as what? Liability, contract liability. Are we okay with this part? Debit, bank, credit, contract liability. Okay. But, ma'am, there is still an exception. Situation 1 or situation 2. Situation 1 says what? Performance obligation is not there. Yeah, performance obligation is done. Control of the building has been transferred to you. Understood. The money is non-refundable. Yes, what I received is non-refundable. Okay. Third condition, in the first situation, the third situation is the money should be substantial. Is it substantial? No, it's only 5% of what is my total consideration. So first situation also failed. Second situation is what? Contract is terminated and money is non-refundable. Contract is not terminated over here. So in this case, whatever I received will be recognized as what? Contract liability. Are we okay? Okay. Are we okay, sir? Yeah, but sir. Tell me, Amit, sir. So in order to apply IFRS 15, what? It should meet all of the conditions, all of the criteria. What are the criteria? Approved contract. The contract should be approved. Your rights can be identified. Payment terms can be identified. There is a commercial substance and it is probable that the jute will receive the consideration due. Munro's ability to and intention to pay are in doubt. That's what, the words that I used while explaining are the same words that you will have to write in the case study. This is a case study, exam case study. I've picked up exactly the same so that you know what are the words that a examiner is looking at. So can I say ability and intention? Now how ability and intention are in doubt? Let me erase this, all of this. So can I say Munro's liability under loan is limited because it is non-recourse. Non-recourse means what? If you do not pay, can I say I can repossess my building. I cannot demand further compensation. So it means what? If Munro defaults, jute is not entitled to full compensation of the amount owed, but only has a right to repossess the building. Okay. Now Munro intends to repay the loan which has a significant balance outstanding. Yes, out of 330 lakh, I've received only 1,50,000. So 95% of my consideration is still due. Primarily from the income derived from its fitness center. Okay. This business is facing significant risks because high competition in the industry and because Munro has very limited experience. Third, Munro appears to have no other income and asset that could be used to repay the loan. Why? Because health food business is in decline and the assets are already pledged as a collateral for other financing arrangements. So it is unlikely they could be sold to generate income and repay the loan. You look confused over here.
Is that mentioned in the question?
Yes, you read this last part. Health food stores are all pledged as a collateral in a long financing arrangement. It means what? Some other long financing arrangement. It has been this. And health food business has declining profits. Okay. So are all, because it has a very limited experience and are all pledged It is therefore not probable that jute will collect the consideration which is entitled in exchange of the transfer of a building. The contract does not meet the criteria of IFRS 15 and revenue recognition model cannot be applied. In the situation where revenue recognition model cannot be applied, IFRS 15 permits amount received from the customer to be recognized as revenue when substantially all of the consideration has been received and it is non-refundable, or seller has terminated the contract. So neither of these are applicable to jute. Therefore, jute cannot recognize the revenue of the consideration received. The amount, this 1,50,000, should be recorded as a liability. Are we okay with this part? Yes, very good case study, right? Okay, now hit me up with your doubts. Yes, sir. Amit, sir, hit me up with your doubts. How was the case study? Good. Now this clears all of your this 5 steps. This is the detailed study that I require from you all. Whenever you study on your own, you should know each and every point. Yes, Amit, sir, please tell me. Where are we? What part we did not understand? Anything that is bothering you, you can always ask me. Can you believe we spent only 1 hour 30 minutes? Not only, we spent 1 hour 30 minutes only on the first step. A lot of is remaining. A lot is remaining. But it was fruitful. Yeah. Did you feel the 1 hour 30 minutes? Did you learn something out of it? Yes. Amit, sir, can we go forward? Okay, perfect. So do you need break or we can study? How? Oh, we can continue. Amit, sir, do you need break? Or we can continue? If you need, you all can tell me. Okay, so it's like 3:20. We take break around 4. Will you be okay with that? Yeah, we can continue. Okay, because if you all are hungry, just let me know. Because it's just 3 of us, we can decide however we like. If it's a huge batch, then it gets difficult to ask the crowd. Okay, guys. So second step. What is the second step? What is the second step of our 5-step revenue recognition model? Identify performance obligation. So, ma'am, what is the meaning of performance obligation? It is nothing but the different promises that you make to the customer. So, performance obligation is, in simple language, can I say, are promises to transfer distinct goods and services to the customer. So, same contract can contain one or more performance obligation. So, for example, our contract, your contract with ArivuPro Academy, we have a contract to do what? To provide you coaching for SBR. We also have a contract to provide you with what? Notes, or maybe some other, recorded lectures and all. So can I say one contract can have multiple promises? So you, as a chartered accountant of any company, will have to identify whether these promises are separate. Separate means what? Are different. Okay. So for example, an entity may enter into a contract with customer to sell a car, which includes 1 year free servicing and maintenance. So car is a separate performance obligation. Free servicing and maintenance is a separate performance obligation. Entity might enter into a contract with customer to provide 5 lectures as well as provide a textbook on the first day of the course. So lectures are a separate performance obligation and this is a separate performance obligation. Now distinct means what? Different, unique. Separate must be identified. Separate promises must be identified, are promised. Now ma'am, when do we say that the performance obligation is distinct or separate? If I take you all back to this, can I say there are 2 conditions? This mind map. There are 2 conditions that say a performance obligation is separate or distinct when customer can benefit on its own by either on its own or by using the resources that are readily available. Now understand, I promised you that I'll teach you SBR. I also promised you that I will provide you with my lectures. You all can lectures, and I will also provide you with notes. Now see, understand, you said, ma'am, I'll prepare my own notes. I will not spend extra for my notes. So can I say, can you benefit from my services on its own without purchasing the lecture? Just try to understand what I'm trying to explain. Can I say, even if you don't purchase the notes separately, if you just purchase the lectures and you prepare your own notes, can you benefit on its own? The answer is yes. So can benefit on its own or by using resources that are readily available. Or maybe you take BPP or Kaplan, readily available material, and you take my lecture, you will be done. You said I will not spend extra for the notes that you prepare. Are we okay with this part? Second, The and it's all together. Both should go hand in hand. Both should be met together. The promise to provide goods or services is separately identifiable from other contractual promises. It means what? My notes are not dependent on my lectures, and my lectures are not dependent on my notes. It means what? There is no interdependence. Not they are independent of each other. They are not interdependent on each other. So here very beautiful word is used in a lot of your case studies. It is called there is no significant integration. There is no significant integration. Integration means what? One is dependent on another. Now let me give you another example. So in this case, what did we conclude? Book is a separate performance obligation and lectures are a separate performance obligation. Why? You can benefit on books separately. If you take just books and you don't buy my lecture, you buy somebody else's lecture, you will be benefited. You buy my lectures, but you buy somebody else's book. Will you be benefited on its own? The answer is yes. My book is not dependent on lectures. My lectures are not dependent on books. So we say there is no significant integration. Both are differently identifiable. So Surbhi will have to treat book as a separate PO and lectures as a separate PO. But now let's say, sir, if I may take your example, you are almost 24, right? Or you're done, you're 24 or you'll turn 24. Okay, next month you will turn 24. So sir will turn 24 next month. Maybe let's say 2-3 years your parents will ask you to get married. Like that's the ideal age to get married, yes or no? So let's say, sir, you decided that you are going to get married. Okay, are you okay if I take the example?
Yeah.
Sure? Okay. So Fayaz sir is going to get married, let's say in next 1 year. Now sir, you hired me as an event planner. You said, Surbhi, please take care of, let's say I am also doing event management also. So I said, sir, Surbhi, you take care of my wedding planner. You be my wedding planner. So what happens over here? What are the promises that I will make to you, sir? Can I say I will, when I'm planning your whole wedding, can I say I will have to take care of your decoration part, the area that you have booked? Can I say decoration will be taken care by me? The catering will be taken care by me. Can I say your photos will be taken care by me? And other things, let's say all those other things are there, no? What is that? People use in weddings. Accessories and all. Team groom, team bride, all of that. Huh? Sorry? Sorry, it is called what? Okay. I didn't know that. Okay. So we stick to these three parts. That is your photo shoot, your decoration and catering. These are the three main things that we have to take care. Now tell me. Individually, can you benefit on its own? If I just provide food, you will be okay benefited. If I provide the decoration, you will be benefited. If I provide the photo shoot, you will be benefited. But are they interdependent? Yes. Imagine I just do the decoration and I run away. Will your wedding be completed? What is the ultimate contract? The wedding. Ultimate contract is not food, catering or photo shoot. Ultimate contract is a wedding. So if I do one and I run away, you will not be benefited. The contract will not be fulfilled. Even though I will say pay me for decoration, you will say I will not pay you for decoration. Why? Because the contract was to get me married, not to just provide decoration. I could, if I wanted it from someone else, I would have taken separate contract. So even though you can benefit on its own, but the contract is interdependent. The performance obligations are interdependent. The food, decoration and photo shoot, all if I should provide together, then and only then I will say that your wedding is completed. So in that case, there is only single performance obligation. In the previous example that we took, lectures is a one performance obligation, notebook is another performance obligation. My goal was to only teach you. My goal was not to provide you with any package or something. You're getting me? So that is why you will have to identify separate performance obligation. So when do we say separate performance obligation exists? When customer can benefit on its own, either with the goods and services there or any other readily available goods and services, not readily available resources. Second, and the goods and services are separately identifiable. Separately identifiable means what? They are not, there is no significant integration. Are we okay with this part? Yes. Now, for example, you gave me a contract to do what? To build a house for you. So there are multiple services provided. Can I say there will be a layering, then there will be a first, let's say 3-4 story building you want me to prepare. If I just prepare one house, one story, one floor, will you be happy with that? No. The contract is to provide you with whole building, not with just one floor. Are we okay? So here the services are interdependent on each other, which is why we say what? There is a single performance obligation. If there is no interdependence and customer can benefit on its own, there is one different performance obligation. Are we okay with this part? Yes, sir. Amit sir, are we okay? Yes. We'll take more examples, but are we okay with the base level part, sir? Base level clarity is there? Yes. So, not this, okay? This significant services will come over here. Significant integration will come over here. No significant integration. Okay. Now, a distinct good. Distinct good or service means what? When do we say the goods or services that we are providing is distinct? If they can be used separately. For example, I offer you classes, I also offer you notes. So student can benefit from material even without attending the class. You just purchase a note, you just go through the note. If your FR is clear, SBR notes will be easy for you to understand. So these are what? My separate performance obligation. So classes is a separate PO, the answer is yes. Study material is a separate PO, the answer is yes. Two separate performance obligations. Are we okay with this part? Okay. Now online course. Let's see. We have another example. A student buys a recorded taxation course. You will get recorded lectures, you will get mock test. Student can attempt mock test separately. Yes, if both are distinct services. Your mock tests are not dependent on course. Your course is not dependent on mock test. Series of services that are the same. So what are we doing over here, sir? I am teaching you SBR. Today you will learn IFRS 15. Tomorrow you will learn IS 16. Can I say essentially what I am providing is the same only? Essentially what you will say, ma'am, I'm going to learn, I'm going for SBR coaching. But every day what you're going to learn from me is different. So here, sometimes a service is repeated many times, but essentially the same service is delivered continuously. What I'm providing is essentially the same only, right? I cannot say June 20 class is a separate performance obligation, June 21 class is a separate performance obligation. Even though what I'm going to do for you is different, but essentially it is the same single performance obligation only. So these are treated as a single performance obligation. Next example, a coaching class. A coaching classes. You enroll for a 3-month audit coaching program. You conduct weekly classes. Even though there are many classes, they are similarly delivered over the same period of time. It is treated as a same performance obligation. Now you can go through this one example, gym membership, whenever you go through your notes. Now I want to talk about goods and services that are not distinct. So for example, sometimes services are so connected that they must be combined. So for example, let's take one example. A coaching institute sells a complete exam preparation package. So we have a residential batch also. I'm not sure if it's still there. There's a residential batch where we take care of the accommodation, food, and also the stay. Your timetable will be decided by us. What you will do on what hour will be decided by us. Like that's a residential rankers program. So let's say we are selling that package. So what will be included over here? The classes. You will get the coaching proper. You will get a study material. You will get test series and personal mentoring. Now all these are designed to work together to prepare the student for an exam. It's all combined together. We're selling a package. We're not selling coaching. We're selling a package. Residential rankers patch. So they must be treated as a bundle. Your wedding. I'm providing you with catering and all of this is combined together, right? So one package is being sold. It means it is a single performance obligation. Are we okay with this part? So in this case, in a residential rankers program, classes is not a separate performance obligation. Study material is not a separate performance obligation. Test series is not a separate performance obligation. Personal mentoring is not a separate performance obligation because we are not selling them individually. We're selling a package. Are we okay with this part? Everybody? So they must be treated as a bundled performance obligation. Yes, sir. Amit, sir. Hit me up with your doubts. Feel free to ask me as many stupid doubts as you can. The only challenge that I give in any batch is irritate me if you can. That's my promise to you. If you can irritate me, go forward. Go ahead. If you're okay, can I expect you to solve one question? Can we try? One question on our own. Would you love to? Would you love to try one question, sir? Okay. Try. How do I say try in Tamil? Sorry?
Muerchi.
Muerchi. Muerchi. Okay, try. Muerchi. I'll read this question for you all. You all try. Office Solutions, a limited company, has developed a communication software package called ComSoft. Office Solutions has entered into a contract with Logistics City to supply the following. Now tell me, who is a seller? Office Solution. Who is a buyer? Logistics City. Okay. Now what are the things that I'm going to provide? A license to use ComSoft. So there is a software. Think of it like Tally. Have you used Tally? Yes. Think of it like Tally. Now since you all are working professionals, I believe Tally is a little bit common. So I will provide you with a license to use Tally. I will also provide you with installation. This may require an upgrade to computer operating system, but the software package does not need to be customized. So it means what? I will provide you with the installation service. It need not be, your package will not be customized, but your operating system, I mean not operating software, computer operating system needs to be upgraded. Tech support for 3 years and 3 years updates of ComSoft. Now additional information. Office Solution is not the only company able to install ComSoft. It means what? You take license from me, you ask Amit sir to install it for you. And the tech support can also be provided by another companies. So let's say you will take license from me, you take installation from Amit sir, you take, let's say Rakesh is also there, one imaginary person Rakesh, you take tech support from the Rakesh, other company. The software can function without the updates and tech support. So it means what? Even if you don't take the tech support, even if you don't take the updates of the ComSoft, the software can work as it is. So it means you take license from me, take installation from somebody else, it will work. So required, explain whether the goods and services are distinct in accordance with IFRS 15. Try. Take 2-3 minutes, think and then give me the answer. Don't rush in giving the answer. Tell me if there is a single performance obligation or there is a multiple performance obligation. How many performance obligation?
I think there should be one.
There's only one. Okay. Sir says one. What do you think, Amit sir? Fayaz sir says one. How many obligations do you think are there? Okay. How do you conclude there's a one?
Because the contract is.
See, when do you say there's single performance obligation? When either of these two conditions don't meet. If both the conditions meet together, we say the performance obligations are separate. So what are the two conditions? Customer can benefit on its own. Second, separately identifiable. It means what? There is no significant integration. So we see, is the first condition has met? Yes. You can benefit from the license. Can you benefit from installation services? Can you benefit from technical support? Can you benefit from updates individually? Third, is there any significant integration? It means what? Is license dependent on installation? No. How do I know this? Because ma'am, the question says that if you take license from me, you can take installation from any other company. It means what? My job is not, my services are not interdependent on each other. Tech support can also be taken from somebody else. So it means what? My tech support is also not dependent on my license. Installation is not dependent on my license. And even update is not dependent on my license. Why? Because even if you don't take the update, you can, the software can function automatically. So both the conditions have met together. So if both the conditions meet together, sir, what happens? The performance obligations are distinct. Distinct means separate. Okay. So the answer is there are 4 POs, 4 performance obligations. Why? Now, customer can benefit on its own. Second, none of this is significant. There is no significant integration in any of these. If they would have said installation is dependent on licensor, in that case, these two would be single PO because there is an integration. If they would have said, sir, technical support is dependent on installation, update is dependent on license, any of these, if they are interdependent on each other, then no. If I'm selling it as a package, then no. We didn't talk about selling it as a package. We didn't talk about interdependence. So these are different performance obligations. Are we all okay with this part? I know where you would have gotten confused is as a package. That's what you were saying. Okay, we are selling it as a package. No. We have entered to supply the following things. We're not selling it as a package. Ma'am, how do we identify if it is not a package, or how do we conclude? What if I feel it is a package? No. If there is a package, the question will be will say specifically, these are all sold as a part of a single package. If the question says like that, okay sir, then it is a single PO. Are we okay with this part? Okay sir, please tell me, Amit sir. So we read the answer now. Is the pace good? Very slow or very fast? Fine, fine. Okay. So we read the solution. ComSoft has delivered. ComSoft was delivered before the goods and services remained functional without any updates and tech support. Yes. So if I just deliver the software to you, and if I don't give you tech support and this updates, then also the software will function. It may be concluded that Logisticity can benefit from each of the goods and services either on their own or together with other goods and services readily available. The promises to transfer each goods and services are separately identifiable. How? Because none of this is not interdependent on each other. Because in particular, installation does not significantly modify software. If I install, it won't modify the software. Only the operating software should be modified. As such, software and installation are separate output promised by Office solution. It means what? I will install, and software is a separate thing, installation is a separate thing. Rather than inputs used to provide a combined output. Even if you don't understand this, even if you don't want to write this technical support, technical language, that's also okay. If you just simply write that these are different performance obligations. In conclusion, goods and services are distinct and amounts to 4 performance obligations in contract under IFRS 15, as each of this would be recognized as a performance obligation is satisfied. Are we all okay with this part? So ma'am, what did we conclude over here? Different performance obligation can be separately identifiable, both the conditions met together, separate PO. If either of this condition do not meet, single PO. Okay. So we quickly revise what we studied till now. We have completed only 2 steps. I have a habit of revising multiple times because this helps us a lot when we, just wind up. By the end of the day, you will feel like this is on the tip of your tongue. So, we started with 5 steps. Okay, we talked together, and Amit sir, even if I cannot see you, but you just talk. You think I'm sitting right in front of you, and in front of the computer only you start talking. Okay. Let people believe that you are just talking to me. Okay. Now, what are the 5 steps first? First one is what? Identify the contract. Second is identify performance obligation. Third, determine the transaction price. Fourth, allocate the transaction price. Fifth, recognize revenue. Okay. Step number 1, identify the contract. We say a contract can be written, verbal, implied. Now, there are 5 conditions. The contract has to meet those 5 criteria to say that IFRS 15 can be made applicable. What is the first criteria? Approved. Second, rights identified. Third, payment terms identified. Fourth, commercial substance. Fifth, collectibility is probable. Collection is probable. Okay, understood. Now we say that if these 5 conditions do not meet, you cannot recognize revenue. IFRS 15 will not be applicable. Okay, ma'am, we understood. But if you receive any money and any of these conditions do not meet, what do? We park it in a separate account in the name of what? Contract liability. Okay, ma'am, we understood that also. But there is an exception to this accounting treatment. The standard says, if the money that you have received and the conditions did not meet, still you can recognize it as revenue in either of these 2 situations. What are the situations? Situation 1 is what? No performance obligation remaining. Substantially all of the money has been received and non-refundable. Second, contract has been terminated and the money is non-refundable. In these cases, even though the contract did not meet any of the 5 conditions, still you can recognize revenue and need not go to contract liability. Okay, with this our first step gets completed. Second step says identify separate performance obligations. So then when do we say that the performance obligations are separate? When these 2 conditions are met cumulatively. Cumulatively means what? Together. So first condition is customer can benefit on its own. Second condition, the promises are separately identifiable. Separately identifiable means what? There is no significant integration. If there is no significant integration, it means what? You can recognize revenue. Are we all okay with this part? Yes, sir. We good. So clear, crystal clear. Up till this part, if I say we spent 2 hours almost. So can I say whatever we learned is in our system and it's all smooth and clear? Okay. Now we go to the step number 4. It usually takes it takes me like around 2-3 hours to complete the step number 3. We see how much time we will take. It doesn't matter. I don't want to bound myself and us in any time. Step number 3 is what? Determine the transaction price. Now here, my dear friends, Amit sir, are we good, right? I mean, I just want you to communicate with me. It would, I'll be more than happy if there are any doubts or anything that you want me to address. So what did we learn when I was preparing a mind map with you all? What did I teach you all? Determination of a transaction price. There are 4 areas that we will have to master. What is the first area, guys? Variable consideration. Okay. What is the second area? Significant financing component. Third area is what? Non-cash consideration. And the fourth area is consideration payable to customer. Okay. Now we start with variable consideration first. Okay. Now my charters, what do you all understand by the word variable? What do you all understand by the word variable?
Change.
It's bound to change. Yes, it varies. It varies. Okay. If I tell you, I'll tell you one secret. Don't share it with anybody. Okay. It should remain between 3 of us. Promise? Sure. Promise it won't go outside of this classroom. Yes, sir. Amit, sir. Yes. Okay. So there's a contract between me and ArivuPro. It says that if there are 2 types of contract actually. The contract changes with what the faculty agrees upon. So the first contract is like if 50% of my batch students, 50% or more, 50% or more. So can I say more than equal to 50% of my batch students get rank along with the fees that they are paying me, fees or salary, whatever name you want to give, they will give me additional bonus of rupees 3 lakh. This is one of the criteria they give to faculties. So 50 or more, if students get a rank, okay, all world rank, all India rank, they will give us additional 3 lakh rupees. Okay. Then the second type of a contract, some of the faculties have that kind of a contract where, let's say my batch has 10 students. Okay, we keep it simple. Let's keep it 20 students. So if 1 to let's say 10 students get a rank, then they will give, let's say, 10% bonus, or I'll put it into money only. 10,000 as a bonus. I'm just giving you a random number. Exact numbers I can't quote, but just understand. If 11 to 20 students get a rank, they will give, let's say, 30,000 as a bonus. If 21 to 50 students get a rank, they might give, let's say, 45,000 as a bonus. Okay. So now, let's say I have the contract agreement between me and ArivuPro is this, where they say at least 50 or more. So what is our batch strength? 2 students. So if one of you get a rank, I will get an additional bonus of 3 lakh. Okay. So can I say this is a variable consideration? Why, ma'am, it is a variable consideration? Because it is dependent on an uncertain event. What is the uncertain event? You all getting a rank. So if you get a rank, I will get a bonus. If you all don't get a rank, I won't get a bonus. Yes or no? Do you all agree with me? Yes. So variable consideration. The standard says, I'll use the technical word now. The standard says, include variable consideration in your transaction price if it is highly probable that significant reversal of revenue will not occur when the uncertainty is resolved. So let's say I have been teaching since last 20 years. Not possible, but imagine. Let's say I have been teaching last 20 years. And all my batch students have been getting a rank. Like we prepared that badly that we get a rank. So can I say I have a good experience in estimating my variable consideration? I know the kind of a coaching we will do over here, my students will guaranteed get a rank. Have you watched that movie, Super 30? Okay. Have you watched that movie? So it's a Bollywood movie where there's a professor, JEE and NEET preparation, engineering preparation. Now there has been a lot of controversy around NEET examinations. So he used to take only JEE, only 30 students. And he used to ensure that all those 30 students get into IIT. That was the intensive coaching he used to prepare. He was somewhere from the north of India, maybe Bihar or Uttar Pradesh. I don't know exactly which state. But it's a real life story of one of the professors. He used to take only 30 students in his batch. So all the 30 students, day and night, they used to study. And he used to ensure that if you are appearing for JEE, you get into the IIT. You get into one of the IITs. So see, I have an experience and I know the kind of a coaching that I'm going to provide. I am very sure 50% or more anyways will get a rank. So can I include this 3 lakh in my transaction price? Yes, because I have an experience. Let's say you are my first batch. You're a, what is that called? Lab rat. You're my experimental batch. You're not, don't worry. I've been teaching last 2 years. Don't worry. His sir's face like, are you experimenting on us? No, not experimenting on you. Okay. So let's say we take an example. You're a first batch that I'm taking. Do I have an experience? No. Can I say whether you all will get a rank or not? No, because I don't have experience. I don't know how effective I'm going to teach, right? So in that case, this 3 lakh will not be included. So tell me, in this situation, can I say, in this type of a contract, can I say either I will get 3 lakh or I won't get 3 lakh? Yes? Do you agree? If more than, let's say my batch size is 10 students. If 5 or more students get a rank, I will get 3 lakh. If 4 students get a rank, even though 4 students get a rank, I won't get a extra 3 lakh. So can I say either I will get 3 lakh or I won't get 3 lakh? Are you all okay with this batch? Yes. So this method of estimating variable consideration is called most likely method. It is called what? Most likely method. So either I am going to get 3 lakh or I won't get 3 lakh. It is a most likely amount. Now here see, when multiple outcomes are possible, when multiple scenarios are there, 1 to 10 students, 11 to 20 students, 21 to 50 students, I will have to, let's say if I have taken up such kind of agreement. In this case, to measure what will be my variable consideration, I will have to check the probability. Let's say I have a very good experience. So I would say, let's say I'll just give you some probability weight. There is a 20% chance that my students' rankers will fall in this category. There is a, let's say, 60% chance that my students will fall under this category. There is a 20% chance my rankers will fall under this category. So can I say sum total is 100? Probability weight has also to always has to be 100. So in this case, how am I going to estimate my variable consideration? 20 into 10,000. 20% actually, basically. 60% into 3,000 and 20% into 45,000. The sum total of all of this is nothing but my variable consideration. So help me with the variable consideration, sir. First one is I know 2,000. 10,000, 20% is 2,000. Second one is how much? 6 3s are 18. How much it is? 18,000, right? 60%, yes. Second is 18,000. And this is how much? 20% of 45,000 is 9,000. Yes, 9,000. Just help me with the number. Not really good with numbers.
Yes.
9,000? Yeah. So what is the sum total? Can I say 29,000? 20 and 9. Yeah. 2,000 plus 18,000, 20 plus 9, 9,000. You know? I know. 2,000 into 20% of 10,000 is 2,000. 60% of 30,000 is 18,000. And 20% of 45,000 is 9,000. So can I say sum total of outcome multiplied by probability is how much? 29,000. So this is my variable consideration in this case. Are we all okay with this part? So this method is called what? Expected value method. It's called expected value method. Are we okay? Okay. So what is the technical language we have to write? Technical language is very, very important. Include variable consideration in transaction price only if it is, I'll use different colored pen over here, only if it is highly probable that significant reversal of revenue will not occur when the uncertainty is resolved. Okay. So there are two methods of measuring your variable consideration, most likely expected value method. I'll go through my notes also. I'll take you all through notes also. First, I like to teach you all this way, then we'll go to the notes. Yes? Yes, sir. Amit, sir. We good? Amit, sir. 1 minute. Yes, yes. Take your time. Take your time. You'll have all the time. Iricha. That's how I say, right? Yes. Amit, sir. Yes. So I go to this part, variable consideration, determine the transaction price. Yes. Transaction price means what? It is the amount that the business expects to receive from the customer. In simple word, it is a total that the customer will pay. So for example, my course fees is 30,000. This is my dish. So what are the things that can affect our transaction price? First one is SFC. I started with variable consideration. SFC will start a little later. It has a little bit of this non-cash consideration payable to the customer. I started with variable consideration. So can I say variable consideration? It must estimate what is the amount it is entitled to. Now what is the main word? What is the line? Include can only be included in the transaction price if it is highly probable that significant reversal of cumulative revenue will not occur when the uncertainty is resolved. This is a standard language. Whatever I used with you all is nothing but it's given in IFRS 15 only. So this is the line that an examiner would want to see when you are writing a case study. If I don't get this, you might lose mark. Okay. So for example, a coaching institute says 25,000 is our fees. A student score above 80% in the examination, 5,000 will be refunded. So can I say what will be my actual fees? Can I say 25,000 or 20,000? It is a variable consideration. So for example, if you get a rank, let's say you've paid a fees of 10,000 over here. If you get a rank, 2,000 will give you a refund. So this is a variable consideration. If you all get a rank, they will have to pay me extra 3 lakh. It is a variable consideration. I will get a fixed fees, but 3 lakh is dependent on something happening or non-happening. Now there are two methods to measure your variable consideration. First one is what? Expected value. What is expected? When many possible outcomes. You will see many possible outcomes. This. Either I can get 10,000, I can also get 30,000, or I can get 45,000. So when many possible outcomes are there, you use which method? Expected value method. So coaching institute offered performance bonus to teachers based on students' result. So possible if a student get excellent result, you will get a 10,000 as a bonus. Good result, 6,000 as a bonus. Average result, you will get a 2,000. Now you will estimate the probability weighted amount. So it means what? Let's say the probability of student getting an excellent result is 20%. This is 60. This is 20. So you multiply. You multiply them, each of them together, and add them. Multiply weighted is nothing but your this variable consideration. So this is how much? 2,000. 6 are 36, 3,600, 2 2s are 4. 400, no? Or 4? Yeah, 400. So this will be your variable consideration. The sum total of this will be your variable consideration. What is the sum total of this? 5,600 plus 400. Can I say 6,000 will be my variable consideration in this case? Yes. Now, when is variable consideration most likely is used? When only two outcome. Either I will get a bonus or I won't get a bonus. So, for example, student gets 5,000 scholarship if they score 85% and above. So either you will get a scholarship or you won't get a scholarship. So above you will get a discount, below no discount. So this is a most likely amount. Okay. Okay, Amit sir. Yes sir. Are we okay? Yes. Did you all make the notes of it? Should we take a small break now? It's 4 p.m. We take a break till 4:40. Then from 4:40, 7:30 continuously, like 3 hours at a stretch almost. In between, if you are like very tired, we can take 5 minutes restroom or water break. Okay, guys. Amit sir, hi. Are we back? Not back. Okay, perfect. So we start. What did we do before break? Variable consideration. What did we learn in variable consideration, sir? That variable, I think I'll take this mic. I might start fumbling. Might not be able to raise my pitch. Am I better now? Yeah, this is much better now. Yeah. Okay. So this is, I think, better than the previous one. Yeah. So we will, what did we do before break, sir? We learned about variable consideration. What is a variable consideration? When do we include variable consideration in our transaction price? When it is highly probable that significant reversal of revenue will not occur. So if you remember, I gave you an example that if I have 10 years of teaching experience and all my students are rankers, so in that case, can I include the variable consideration? Yes. Can I include variable consideration in the transaction price? Yes. But if I don't have an experience, it should not be good for me to include, because I'm not sure if I include today, tomorrow I will have to reverse it because I might not get it. Yes. So keeping that perspective in mind, keeping that knowledge in mind, we discuss one question. My theory is same, that first you all try, then I will come into picture, because what I have learned from my student experience, when I've been a student like for almost 23 years of my life. So I think what I've learned from these days is that when what you remember the most is your mistakes. If you ask me today, I'll tell you all the mistakes that I made in my CA final examinations. I won't know the questions that I did right, but I do remember all the questions that I did wrong. So that's what I remember. That's what I have learned. So I hope it works with us also. So try this question, and I'll read the question and you all try, tell me what should be done. I'll decode the question for you all. You all say, 1st December 2001, Bristow provides, whatever is the pronunciation, Bristow provides a service to customer for next 12 months. So can I say it will be over the period of time? The service, we try to understand how we do. The consideration is 12 million. So can I say this is my transaction price? Bristow is entitled to an extra 3 million if after 12 months the number of mistakes made fall below a certain thresholds. So what do you think is 3 million? Variable consideration. Wow, amazing. Love this answer. Can I say why? Because it is dependent on what? An uncertain event. That is what? Number of mistakes. So if number of mistakes made fall below a certain threshold, I will get what? 3 lakh. If they don't fall below a certain threshold, I will get what? I will not get 3 lakh. So tell me, which method, sir? Most likely or this? Most likely. Yes. Either I will get 3 million or I won't get 3 million. So can I say? Most likely. Amazing, amazing. So discuss. Now we are standing on 1st of December 2001. Discuss the accounting treatment of the above in Bristow's financial statements for 31st December 2001. If they have put you in a two situation. First, if Bristow has experience in providing identical services and it is highly probable number of mistakes made will fall below the certain threshold. Now also, second situation, Bristow has no experience and it is unsure if the number of mistakes will fall below the certain threshold. You are required to give me the accounting treatment. Tell me how much of the revenue should be recognized in Bristow's financial statements under both the situation, under A and under B. You all take 2-3 minutes and tell me. Dates are very important. We entered into the contract on 1st December 2001. We are standing on 31st of December 2001. Tell me. Dates are very, very important. Think about it and tell me. What do you think, Amit sir?
1.25 million.
In the first case, 1.25. Okay. How did you get 1.25?
So first of all, they have experience. And
Uh-huh.
It's highly probable that the mistakes will fall below the threshold.
Uh-huh.
So we'll consider the extra consideration. The variable consideration is actual revenue.
Hmm.
So we'll get 15 million.
Perfect.
Divide that by 12 months.
Perfect.
So for 1 month, we'll get
1.25 million. Amazing. For the second one?
the second one. Since they are unsure,
Uh-huh.
so we'll only take the 12 million as revenue and we do the same thing. Divide it by 12 months.
So it will be 1 million. 12 million divided by 12 months, 1 million. Ish. Good, good, good. Let's say. Oh, amazing. You're absolutely correct. So you were I am still wondering, why did you give yourself 5 out of 10?
Well, thorough with a few.
So this one you're thorough with. That's good. So I think you should have given yourself 7.5 at least. What do you think, Amit sir? Waiting for your answer. Make mistakes. No worries. Nobody's gonna judge you. We are just as clueless as you are, sir. Even I am learning, even you are learning, sir. So don't worry. You understood it? Okay, you understood it. So we discussed this solution. So what is my fixed consideration? 12 million. What is my variable consideration? 3 million. In the first case, since I have an experience, so it is highly probable that significant reversal of revenue will not occur. So in this case, in the first case, what will be my revenue? What will be my transaction price? 12 plus 3, 15 million. Now this is to be spread over next 12 months. So divided by 12, we have to recognize revenue only for 1 month, 1st December to 31st December. So can I say 1.25 million? In the second case, I don't have any experience, so I will not include this extra 3 million. So in this case, 12 million divided by 12 months, it gives us $1 million. Are we okay with this part? Easy. So in the first case, so I'll read and how you have to. Now we know the numbers, ma'am. Just knowing the numbers, just knowing how to calculate won't fetch us marks. How to write. SBR is all about how well do you present your answer, right? So just knowing the answer won't get you marks. So first, can I write 12 million is a fixed consideration? Okay. 3 million is a consideration dependent on mistakes made. Therefore, it is variable. Now you must estimate the variable consideration. So you use which, expected or most likely. Since there are only two outcomes, either 0 or 3, then which amount is which is the estimation method? Most likely amount. Yes. Would better predict the consideration. Now you expect to hit in the situation A, you expect to hit hit the target. So most likely amount variable consideration is 3 million. In the second case, you must decide whether to include the estimated variable consideration in the transaction price or not. Based on the past experience, it seems highly probable significant reversal of revenue will not occur. Therefore, 15 million is my consideration. As it is likely to be satisfied over time, that's why I asked you, satisfied over 12 months. So your 1 month revenue will be what? 1.25. Next, here it is estimated on likelihood of hitting the target. Variable consideration would be estimated. Okay, we know this already. Since it cannot be included, why? Because it is not highly probable that it would not occur. Therefore, since you have no experience, therefore the transaction price is 12 million. In this case, your revenue will be how much? 1 million. Easy. Are we okay with this part? Yes, sir. Are we okay? So are you okay? How do we write it? What we have to use, you remember you see the words that we use in my explanation, the same words have been used in writing the answer. I'll not use any easy words so that you find it difficult to write the answer. Whatever words we use in our communication, the same words, I'll try to keep it as technical as possible so that your brain doesn't think about anything. So for example, if I say any other word for highly probable, then your brain will start framing answer in that way. Now, whenever you have to write a case study or solve a case study, you will automatically think about highly probable, significant reversal and all of that. Are we okay with this part? Okay. Okay, this part will do because we have not done right to return part. This part you all can wait for few minutes. Right to return I have not yet discussed. Right to return is this, a special cases. You remember the special cases that we were talking about? The very first discussion is what? Sale with right to return. This I will take a little later. Once we complete all the five steps, then we'll go to sale all these steps. Okay. Now I will go to what is our next area in our transaction price. First area are we comfortable with? Variable consideration. What is the next area? Significant financing component, right? So we are, can I say we are done with variable consideration. Next is significant financing component. This I will take a little later. First we complete these two. These two will hardly take 5-10 minutes each. 10 minutes each it will take. We first talk about non-cash consideration. Okay. What do you all understand by the word non-cash consideration?
Paying in another form.
In a?
Not giving us cash.
Is not giving us cash. It's giving us bank money, check.
That's also cash.
That's also cash, yes. That's what I wanted to know. It just, okay. So what could he possibly giving me? Shares, yes. What else? What else? Assets, yes. Yes, sir. What do you understand by, sir, non-cash consideration? What do you understand by non-cash consideration, sir? So can I say in this case, whatever I receive will be in form other than cash. Consideration in anything other than cash. Yes, I guess, is it? No. Goodwill will come only with group accounting, sir. No goodwill. We will not, in revenue, goodwill will never ever come into picture. So, no goodwill. So, consideration, okay, you mean to say the way we calculate goodwill, the consideration, non-cash consideration, shares and all. Yeah, you can say, sort of it is, but goodwill calculation will not come into picture, okay? Okay. Yeah, you can say, okay, if you remember the consideration is settled in cash, contingent consideration, deferred consideration, if you're talking about slightly that only concept, but in IFRS 15, what happened, sir? All good? Feeling cold or something like that? Want me to turn off the AC or anything? So, consideration other than cash. Ma'am, what can be the possible thing that we can receive? Can I say we can receive shares? We can receive assets. We can receive any inventory. Inventory is a part of asset only, but anything other than cash. These are the possible things that we can receive. So, ma'am, how do we account for it? So, I'll give you two very simple examples. With these two examples, we'll be done with this. So, sir, I'll tell you one thing very honestly. I'm very new to Chennai. Like, this is my second visit to Chennai. I never came here before. So let's say you got to know that I am, my examples will be very stupid, but concept will go smoothly. So let's say I came to Chennai and you realize I'm very new to Chennai. So sir, you said, Surbhi, let's do one thing. You teach me SBR. You're anyways going to be here for 3 months. Instead of you eating outside, I'll take care of the food. You say, ma'am, breakfast, lunch and dinner, I'll take care. I'll get it for you. Just as you, hypothetical situation. So here, can I say, I'm a service provider and you are a customer. You are settling my consideration in the form other than cash, where you are taking care of my lunch, breakfast and dinner. Yes or no? So here, the standard says, Surbhi, now the question is, Surbhi, how will you account for it? How much money have I received? Because accounts understand only money language. Accounts will not understand debit, breakfast, credit, revenue. Accounts will not understand debit, lunch, credit, revenue. I mean, you're getting me? So accounts will understand only monetary language. How do I account for it in the monetary terms? So standard says, IFRS 15 says, Surbhi, if you can, the first preference will always be given to fair value of what is received. Fair value of what is received. So tell me, you all are going to be a future affiliates, future ACCAs, future finance professional of this country and of this globe. Tell me, can you measure the fair value of what you're going to pay me for, how you're going to like lunch, breakfast, and dinner? It's not possible, because sometimes you might get upma for me, or some days you might get a biryani for me. Are you getting me? So the fair value is not determinable, because you're not a seller. You're not selling. You're not owning a restaurant. You're getting it from your house. So you cannot determine the fair value of lunch, breakfast, and dinner. So ma'am, what if I cannot determine the fair value of the consideration received, what I've received? I cannot determine how much will one plate of upma will cost, how much one plate of biryani will cost, because you're not a restaurant. If you are owning a restaurant, then okay, understandable. You're not owning a restaurant, you're getting it from your house. Your mother cooks for you and you're getting it for both of us. So the standard says, if you cannot determine second preference, when will it come into picture? When fair value of what is received cannot be readily determined. It's not, or cannot be, or is not readily determinable. It means what? I cannot determine the fair value of what I have received from you. So standard says, in that case, the selling price, I'll use a different color. Selling price of goods and services provided, of goods and services provided will be your fair transaction price, will be my transaction price. So if I can determine the fair value of what you have given to me, that is my transaction price. Let's say I could determine the fair value of lunch, dinner, and breakfast for next 2 months. Let's say the fair value of that is 20,000. So 20,000 is my transaction price. Now if I cannot determine the fair value, then what is the selling price of goods and services provided? So let's say one batch of SBR we charge 25,000 rupees. So 25,000 will be my transaction price. Are we all okay with this part? Yes, sir. Are we okay? So that's all. Yes, Amit sir. Are we okay? Please tell me. Good to go? Or not good to go? Yes. So that's all. This part is also done. We're also done with the non-cash consideration. Now we do one sum on non-cash consideration. Non-cash consideration. Okay. What did we learn over here in non-cash consideration? Any non-cash consideration is measured at fair value. If the fair value of non-cash consideration cannot be estimated reliably, then the transaction is measured using stand-alone selling price of goods and services promised to the customer. If I can measure the fair value of what you've given, that is my transaction price. If not, then the goods and services provided. Okay. Now I want you to try this question. Okay. Try this question as I always practice. You'll read and try. Okay. So guys, try this question. I'll come into picture after 5 minutes. I mean, not 5 minutes, 2-3 minutes. I think it should not take more than 2 minutes for us to solve this. Ask.
First, there's a change in the fair value.
That's the only story. Yes, considered. Yes. Amit sir, absolutely correct. Okay, tell me. We read the question and I'll ask you the counter question. When I ask you the counter question, your answer will be solved. So Dan sold goods to Stan. Control. What is the triggering point of our IFRS 15? Performance obligation. What did I teach you? When the performance obligation is satisfied, please recognize revenue. When the performance obligation is not satisfied, you don't recognize the revenue. So control of the goods transferred on 1st January. So can I say control means what? My promise is fulfilled. You and I entered into a transaction to sell this water bottle. I transferred the control of this bottle from me to you on 1st of January. Tell me, when should Surbhi recognize revenue? 1st of January. Yes. So when did the control transfer? 1st of January. So fair value on 1st of January will be my transaction price. Okay. So the consideration received by Dan was how much? 1000 shares. In Stan with a fair value of $4 each. So what is my transaction price? 1000 shares multiplied by $4. I'll tell you the further accounting treatment. I will also tell you. Now, at 31st December 2001, shares in Stan had a fair value of $5 each. How much revenue should be recognized in the financial statements of Dan at 31st December 2001? Now tell me one thing. What will be the journal entry of this? One thing I know, ma'am, corresponding credit will go to revenue. I told you the fair value also, 1000 shares into $4. Why? Because the control transferred on 1st January, so you will recognize. So 4000 will be my this. The debit goes to what? Debit goes to bank, debit goes to receivable, debit goes to what? Bank. I didn't receive money, right? My bank account is not debited. I mean credited, basically. I didn't receive any money in my bank. Yes, Amit sir, absolutely correct. No idea. What did I get, sir? Can I say I got shares in Stan? I got what? Shares of another company. Now here both are company, right? Stan. So if I got shares in Stan, it means what? Stan is a company only. So can I say I will debit investment in equity instruments? Yes, will you be okay with this? 4000. Now, IFRS 15 job is done till this. Once something goes to P&L in the name of revenue, IFRS 15 is out of the picture. Investment in equity instrument are accounted using which standard? Investments with standard? Yes, sir. With standard. Amit, sir. Yeah, you are correct. Sir, you just said something. You didn't? Investments. Yes. By any chance, sir, do you remember? Huh? Sorry? 40. Yeah, investment property, but not 40. Investment in equity shares, not 40. It is accounted using IFRS 9. IFRS, yes, financial instruments. This is a financial asset. The very first definition of financial asset says financial asset is a cash or investment in another entity. Investment in equity instruments of another entity. So investments in equity instrument is nothing but my financial asset as per IFRS 9. So ma'am, as per, let me give you a little bit of idea of IFRS 9 also, because it is a merger of two standards. So IFRS 9 says, if you have investment in equity instruments, you have two policies. A company has only two accounting choices. Either you can measure fair value through P&L or fair value through other comprehensive income. So if the company has chosen to measure it as fair value through P&L, this change of 1000 you understood, from 5000 and 4000 to 5000 will go to P&L. If the company has chosen to measure it at fair value through other comprehensive income, the change will go to where? Other comprehensive income, OCI. So ma'am, what will be the journal entry on 31st of December? The company will pass this journal entry on when, sir? 1st January 2001. This is a journal entry company will pass. When I am standing on 31st of December 2001, now it will change depending on the company policy. Let's say the company's policy is to measure at P&L, or let's say the company's policy is to measure at OCI. So if the company's policy is to measure at P&L, can I say here company will debit investment because the fair value has gone up, my investment value should go up. Investment in equity instrument, 1000. Are you okay by 1000? From 4000 to 5000 I have to go. So the balancing figure I will increase. Credit P&L 1000. If my policy is to measure at fair value through other comprehensive income, I will debit investment 1000 and I will credit OCI 1000. Okay. Yeah, so it's basically here up till this point IFRS 15 job is done. This is basically as per IFRS 9. Easy. Now are we okay? Crystal clear? We know this further accounting also. Yes, sir. Even though this is not asked in the question, they have asked us only how much revenue should be recognized. So they just want us to tell this. I told you the further accounting treatment also. Yes, sir. Easy, simple. A little bit. Since if it was my FR batch, I would not have asked this because they don't know. In SBR, a little bit of, because you might not remember exactly, but if I just give you an idea, if I just talk about the topic, you would know. Okay, yeah. Okay, this is something what we would have learned. You might not remember exactly, but a little bit if I give you a hint, you will be able to recall. Were you able to recall a little bit? Yes, sir. Amit sir, were you able to recall? Yes. Okay. So we read this answer. We read the answer. Consideration is a non-cash consideration. Yes. Why? So non-cash consideration is measured at fair value. Revenue should be recognized at on 1st January at 4,000. Any subsequent change is any subsequent change in the fair value is not recognized within revenue, but instead accounted for in accordance with IFRS 9 financial instruments. So subsequent change, we know how. If OCI, then OCI. If PNL, then PNL. Okay. Yes. Are we good? So we are done with this second part also. Do you want to write anything about this? Like, you're done with the notes part, right? All the notes. Okay. Now we talk about the third part, the last part, not the last, but the third part, that is consideration payable to customer. Consideration payable to customer. Consideration payable to customer. Now, sir, here I will have to, I'll just take one example and that will be very simple. So do you have any business, like do you run any business or anything? Amit sir, by any chance, do you run any business? Do you teach anything or anything like that? Okay, if you don't have, but in future, if you want to start a business of your own, what it would be? Just one, choose one thing that is very close to your heart. If you ask me, I think it will probably a restaurant. I would want to start a restaurant. So anything that is close to your heart, you can tell me, because I want some principle to principle discussion. Like, tell me, sir. Amit sir, you can also tell me what is your business, dream business. We all have, everybody at this stage, we all have some or the other business ideas that we want to, if we had money, we would definitely want to fulfill that. So tell me.
Consider bottled water.
Bottled water. Okay, nice, interesting. Yes, sir. Amit sir. Do you have any business ideas, any dream business that you would like to start? No? Okay, sir. No, ma'am, I'm just a student right now. My dream business is to only make profit. Okay, no worries. So, sir, let's take Abdul sir wants to start a business of bottled what do we say? Bottled waters, right? Bottled water, what? Mineral water. Yeah, I spell correctly, like I didn't make. So, sir, understand. Let's say I'm teaching you SBR. Now, your bottled water will be non-cash consideration. It will form part of a non-cash consideration. Let's do it differently. Yeah, we keep it this only. So I'll draw something over here. This is Surbhi. This is Abdul sir. Okay, sir, we have two transactions. We have you and I entered into two transactions. Let's say I am teaching you SBR. In return of my teaching, you will pay me, let's say, 10,000 rupees. You will pay me how much? 10,000 rupees. Now we have another transaction wherein you will provide me 10,000 bottles. You will provide me 10,000 bottles, or let's say 1,000 bottles of 10 each. So that will make it 10,000. Or let's say, no. 2,000, that will be 20,000. No, I want something less than this. So let's say you will provide me 50 bottles of 10 each. That will be 500, right? Now in this, in return of this, how much I have to pay you, sir? Can I say? Here I will be paying you some money. Yes, Surbhi has to make you a payment of how much? 500 rupees. Yes. Okay. So Surbhi is providing you with what? SBR, and you are providing Surbhi with 500 worth bottles. Now the question comes, Surbhi, when Surbhi is recognizing revenue, we strictly speak from Surbhi's perspective. Surbhi, whether you should recognize revenue of 10,000 or 9,500. Tell me.
9,000.
9,500. So Surbhi should recognize a revenue of 9,500. What do you think, Amit sir? Okay, I'll just show you. Surbhi's P&L should look like this. By revenue 10,000, to purchases 500, or by revenue 9,500. Which one you say, sir? This one, right? And Amit sir says this one. The standard says, Surbhi, if let's, here I am paying something to customer, right? So it is a consideration payable to customer. You are my customer, I'm paying you something, right? So standard says, Surbhi, whatever you are paying to your customer, if it is in return of distinct good or service, am I getting something in return from you? Yes. So that should be accounted as a separate purchase transaction. It means your revenue will be recognized at gross. You will not reduce it from your revenue. Okay, ma'am. Now I change the example. I say, sir, I will teach you SBR. But now to learn, to access my video lectures, to access my video recorded classes, you will have to do what? You will have to download a software. And that software installation will cost you 500. So a lot of people will be like, ma'am, I'm already paying you 10,000. I additionally pay you this also. So I said, sir, don't worry. I will reimburse you. I will reimburse your cost. Extra anything that you have to pay, the company, the organization will refund you, will reimburse you. So standard says, if Surbhi, you're paying if you're paying something to your customer, that is not in return of goods and services. Am I getting something for this 500? No. I'm just compensating you, or I'm just giving you a discount. Think of it like this. So in that case, this 500 will be treated as a reduction. So I will recognize revenue of 9,500. So ma'am, what do we have to remember? If Abdul sir is giving something in return of 500 to Surbhi, the P&L should look like this. If Abdul sir is not giving anything to Surbhi in return of what money Surbhi is paying to Abdul sir, the P&L should look like this. Easy? Easy? Amit sir? I Richa?
Like a cashback, right?
Yeah, cashback. You can think of it like a cashback, discount, refund, compensation, whatever name you want to give. We get a cashback from, big organizations like, what is that, Lifestyle, Reliance, and all of that, like that. Yes, sir. Okay. So we read. Now when we read the content, you'll be like, ma'am, that's so simple. Why is it so technical? So the standard says, if the consideration is paid to customer in exchange of distinct good or service, the water bottles, then it is accounted as a purchase transaction. That's what we did. Yes, water bottles accounted as a purchase transaction. But assuming that consideration is paid to customer is not an exchange of a distinct good or service, then entity should account it as a reduction from the transaction price. So in that case, it will be treated as this. Easy, simple. Okay, so you all can note down this part and then we'll solve a question. Do we have a question on this? No, I don't think we have a question on this. We'll see. There's a combined question. We'll solve that. Done? Okay. Now we go to the very, very important discussion, that is your nothing but significant financing component. The reason why I kept it towards the end is because it requires a lot of our brain energy. Significant financing component. Are we fresh? Can we discuss, Amit sir? Would you like to discuss the new significant financing component? Good, fresh. Okay. So for next 15 to 20 minutes, don't write anything. just try to listen to me, what I'm trying to say. And if you just patiently listen to me for next 15-20 minutes, the significant financing component is in your pocket. Like, you'll never lose marks on this. So we try to understand this. Significant financing component. Now, the first question that I want to ask you all is, what do you all understand by the word financing? What do you all think? What does the word financing mean to you? Like, what do you think the word financing is all about? Think about it and tell me till the time I will.
It involves loans.
Yes, loan. Perfect. Financing. Whenever we hear the word financing, basically we are talking about the loan. So understand, there are two indicators of a financing component. So it means what, sir? When I'm talking about financing, significant financing component, there can be two possible scenarios. Either the customer, yes, investments, loans, yes, perfect, amazing, Amit sir, good, we are going good. So I am a service provider, you are a customer, sir. Either Surbhi has given a loan to you, or you have given a loan to Surbhi. Either seller has given a loan to customer, or customer has given a loan to seller. That's how it will be. These are the two possible scenarios. These are the two possible accounting treatment. Okay. So, ma'am, what are the indicators? First, ma'am, how do we identify that there is a significant financing component? So, we understand there is a first indicator. The first indicator of your significant financing component indicator 1. Indicator 1 is what? There is a difference. There is a difference between cash selling price and transaction price. Ma'am, what do you mean by this? So cash selling price is what? Nothing but individual selling price, standalone selling price, and transaction price is what I am charging from you. So let's say in our scenario, the cash selling price of SBR course, let's say cash selling price of SBR course is 12,000. Okay, but I am charging from you is 13,100. Is there a difference? Yes. So this 1,100 is nothing but interest. When there is a loan, there has to be an interest. Either interest will be received or interest will be given. Are we okay with this part? So in the question you see that there is a difference. The question will be specific. We'll do one question that will make it very simple. So can I say, in this, if there is a difference between your cash selling price and the transaction price, there is an element of financing in your transaction. Are we okay with this part? And second indicator number 2. We talk about indicators 2. Indicator 2, there is a length of time. There's a, or rather I would write gap between performance obligation and payment date is more than 1 year. Okay, so let's put it in this way. So tell me, what did we learn so far? Can I say the triggering point of our revenue recognition IFRS 15 is satisfaction of performance obligation? If I'm done fulfilling my promise, can I recognize revenue? Yes. Whether you have paid me or not, it doesn't matter. If you have paid me in advance, but I'm not yet done teaching, I cannot recognize revenue. But if you have paid, if I'm done teaching to you, but you have not paid me, I can still recognize revenue. So, sir, here there can be two possible scenarios. Okay. The two possible scenarios in this case can be PO. Are you okay if I write PO? Performance obligation. The first possible scenario over here is PO is done. Performance obligation is done. But payment is pending. But payment is not done. Possible? Second scenario is where your payment is done. Payment is done, but performance obligation is not done. PO is not done. Are we okay with this part? So I'll just put this in our example. Let's say today you come to me and you say, Surbhi, you teach me, but I will pay you 2 years later. See, the gap has to be more than 1 year. Okay, that's the reason. You said, sir, madam, I will pay you 2 years later. You teach me today, but I'll pay you 2 years later. Okay. Sleepy, yeah? It's okay, you can yawn freely. No worries. Just, no, don't worry. Don't worry. You want coffee? Shall we get a coffee for both of us?
I just drank tea.
You just drank tea? Okay. Okay. So, sir, here what has happened? Can I say PO is done? We'll first analyze one scenario in depth. My PO is done. Performance obligation is done. So, if I have to talk about journal entries, can I say I can credit revenue? Yes.
Yes.
PO is done. Performance obligation. Triggering point is what? PO. So can I say I can credit revenue? But payment is not done, sir. So I cannot debit bank, right? So the debit goes to what? Receivable. Debit goes to what? Receivable. Can I say, if you remember your IFRS 9, receivable is nothing but financial asset. So the standard says, when the performance obligation is satisfied, Surbhi, but payment is not done, the payment will be made 2 years later, Surbhi. In this case, it is assumed that the entity, that is Surbhi, has given a loan to Abdul sir. Are we okay with this part? Okay, ma'am. So it means, Surbhi, if you have given a loan to Abdul sir, will you not charge interest? I will charge interest if I have given a loan. So interest, if I charge interest, it will be what? Interest income or interest expenditure for me? What it will be? Interest, it will be an income or an expenditure? Income. Ayyo, it will be income. So 11th and 12th, interest income. Credit all your incomes and gains or debit all your incomes and gains. Credit. Why are you confused? So credit, interest, income. Yes or no? Going forward, I will have an interest income. The corresponding debit goes to what, ma'am? The corresponding debit goes to your receivable. That is nothing but your financial asset only. Are we okay with this part? Okay, ma'am. Ma'am, let's say 2 years have been lapsed. 2 years you kept your interest income. 2 years later, Abdul sir finally made you the payment. So whenever Abdul sir makes me the payment, can I say, I will debit bank, sir? Yes. And I will credit receivable. I will have to derecognize my receivable now. I will have to derecognize my receivable. Are we okay with this part? Okay, ma'am, we understood a little bit, but let's take numbers now. Numbers make more sense, right? So let's say, I'll put numbers now. A little bit of changes here. So Surbhi is done teaching to you, sir. You said, Surbhi, 2 years later, I will pay you $1,21,000. How much I will pay you? 1,21,000. Now that I've involved numbers, I will ask you one more question. So tell me, when will you pay me? 2 years later. When will I recognize revenue? Today. So tell me, 1,21,000 2 years later and 1,21,000 today will be same? No, it won't. What will come into picture? Inflation. So can I say interest will come into picture? Yes. So can I say, if I take you back to your MA days or your childhood days, can I say this is a future value? Will you agree with me? It is a future value. You will pay me, sir, 2 years later. I want to recognize revenue right now. So I cannot at any cost recognize at 1,21,000. Yes. So standard says, Surbhi, bring it to present value. So which rate, ma'am, you will take? The question comes, ma'am, rate has to be taken. Rate applicable to whom? Rate applicable to you or Abdul sir. So tell me, in this scenario, when my performance obligation is satisfied, but you are yet to make me the payment, who has given loan to whom? Surbhi. So can I say entity has given a loan to customer? So in this case, borrowing rate applicable to the customer. If Abdul sir wants to borrow from the bank, how much bank will charge interest? The same rate I will take. So let's say your borrowing rate applicable to you is 10%. So using this rate, I will have to bring the present value. Do we know the discounting?
Yes.
Yes, sir. Amit sir, do we know the discounting? Yes. So tell me, help me with what is the present value. If you don't know, I'll show you the formula that we use. You take your future value divided by 1 plus 10% raised to 2. Now why 2? This is nothing but number of years. This is my rate. 1,21,000 is my future value. Yes. So what is my present value? Help me with the present value. Please calculate and help me. If you need calculator, sir. Oh,
Value.
well, okay. If you are comfortable with phone, good. Amit sir, are we okay with this part? Yes, yes. Help me with the present value part, sir. 1 lakh. Yes, 1 lakh. It will be 1 lakh. One lakh. So can I say this is my present value? Can I say this is my present value? So ma'am, now whatever journal entries you taught us, let's put all of this in this number. So sir, I can recognize revenue at 1 lakh. I can recognize my revenue at 1 lakh. So day 1, what is the journal entry I'm going to pass, sir? Can I say debit, receivable, credit, revenue. Instead of receivable, if you write financial asset, that is also okay. 1 lakh, 1 lakh. Okay. Going forward, I will have interest income. Yes, sir. So the same rate that you used to do the discounting, we will do the unwinding of our present value. That is nothing but my interest income. So can I say credit interest income, credit all your incomes and gains. So credit interest income. Now in technical language, we also call it as finance income. Okay. So it will be how much, sir? 1 lakh is my in opening balance of my receivable. So 1 lakh into 10%. Into 10%. How much it will be? 10,000. So debit your receivable 10,000. Yes. Are we okay with this part? Now see, tell me one thing. This is my P&L item or balance sheet item? P&L item. This is my balance sheet or P&L item? Balance sheet item. So P&L will not have a balance. P&L item doesn't have opening or closing balance. So this has gone into P&L. This has become part of my profit. This is my balance sheet or P&L item? Balance sheet. This is my P&L or balance sheet item? P&L. So this has gone into my P&L, has become part of my profit. Now tell me, my opening receivable on day 1 when I recognize my revenue, my receivable had a balance of 1 lakh. By the year end, I recognize I increase my receivable by one more 10,000. So what will be the closing balance of my receivable? Perfect. 1 lakh plus 10,000. Can I say the closing balance of my receivable will be 1,10,000. Now you will pay me 2 years later. So second year also I will have to accrue my interest income. So again the same journal entry, credit, interest income. Now what will be the balance? Can I say 1,10,000 into 10%? 1,10,000 into 10%. It comes to how much? Can I say 11,000? Yes. Debit. Again receivable 11,000. Now tell me, what will be the closing balance when I'm standing at second year end? First day 1, I recognize this journal entry. First year end, I pass this journal entry. Second year end, I passed this journal entry. Now second year end, you will make me a payment. Now tell me, what will be the balance of my receivable? Can I say opening balance 1 lakh?
1 lakh.
Plus 10,000 plus 11,000. Are we okay with this part? What will it be? It will be 1,21,000. This is what you promised to pay me 2 years later. Yes. Our initial agreement was what? You said, Surbhi, I will pay you 1,21,000 2 years later. Now my receivable in my balance sheet, my receivable is appearing at 1,21,000, sir. Yes. And you will also pay me. So can I say, when you make me the payment, when you actually make me the payment, I will debit my bank.
Yes.
I will get 1,21,000. I will credit receivable. So I will de-recognize my receivable. I will credit my debit my bank. Are we okay with this part? So with this, my journal entry will get closed. Are we okay? Easy? Simple? Yes, sir. Tell me. Are we okay, Amit, sir? Yes. Easy? Crystal clear? So what do we need to remember over here is this rate. Rate applicable to whom? Customer. Rate applicable. So can I say borrowing rate of customer? Easy peasy. Yes, sir. Everybody. Okay. So first scenario is okay. If performance obligation is satisfied but payment is pending, you will do what? You will credit the revenue. Why you will credit revenue? Because the performance obligation has been satisfied. The customer has not yet paid. So you are yet to receive. So you recognize receivable. It is nothing but a financial asset. Now going forward, you will have an interest income on your receivable. Every year you will pass this till the time you satisfy your performance. Till the time customer actually pays you. When the customer actually pays you, you will debit back and you will credit your receivable. Okay. Now, let's say the reverse situation where you say, Surbhi, when I'm done teaching to you, when you made me the payment today itself, you said, Surbhi, take payment today. But I said, sir, I will not be able to teach you today. I'll teach you 2 years later. Okay, here the time gap. Why am I using the word 2 years and 3 years? It's because I want time gap more than 1 year. Because there's a slight, going forward, I'll teach you something called as contract asset and contract liability. In that situation, sir, there's a thin line of difference. We'll prepare similar chart. Similar chart we'll prepare, but there's a thin line of difference between contract asset and financial asset, financial liability and contract liability. Okay, so here payment is done, but performance obligation is not satisfied. So tell me, can I credit revenue? Can I credit revenue? Tell me. Amit sir, tell me, can I credit revenue? Debit bank, I know. Payment is done. Debit bank, I know. But say, can I credit revenue? IFRS 15. We are solely speaking from IFRS 15 perspective. No. Why we can't do it? Madam, performance obligation not satisfied, ma'am. Why recognize revenue? So revenue will not be credited. So ma'am, what will be credited? Here it is assumed that Abdul sir has given me a loan. You've paid me, but you said, Surbhi, okay, teach me 2 years later, I am okay, I'll wait. So here, since you have given me a loan, so it will be what? A liability, a financial liability. Okay. Now, a lot of people ask, ma'am, can I write payable over here? You can. Payable is nothing but a financial liability only, but I would recommend write financial liability. Here also you can write financial asset, that is also okay. So can I say I will credit what? Financial liability. So we know as per IFRS 9, financial liability is nothing but a loan. So loan, or can I say a financial liability? Financial liability. Are we okay with this part? Okay, ma'am, we are okay. Now, if I have taken a loan, sir, so whose rate will be applicable? My rate. Because I have taken the loan. So today, if I go to the bank and I ask for the loan, whatever rate bank gives me the interest, that will be the rate applicable. So can I say here, if I have to write over here, rate applicable to supplier. Yes, here rate applicable to whom? Customer. Rate applicable to customer. Okay, ma'am. So rate applicable to supplier you are going to take. But tell me, we'll have interest income or interest expenditure, sir? Expenditure. So tell me, debit all your expenses and losses. Yes, that's what we learned, because at least that's what my accounts teacher taught me in 11th and 12th. I hope that we are okay with this. Yes. So can I say debit? Interest expense. It is also called sometimes finance cost. Credit what? Financial liability. Your financial liability will increase, right? Credit financial liability. Yes. I did. Okay. So ma'am, what will happen when you are done teaching? 2 years later, ultimately you will teach, right? You've received money, so you won't keep the money with you. You will have to teach, right? So whenever I am done teaching you, sir, I will de-recognize my financial liability. Okay. And I will credit revenue, because now my performance obligation is satisfied. Now I can finally recognize revenue. Easy. Okay, ma'am. Numbers would help us understand more. Yes. So let's say you paid me $1 lakh. We'll use the same numbers. Okay. Let's say, sir, you paid me $1 1 lakh advance. PO will be satisfied when? 2 years later. Rate applicable 10%. Is what? 10%. So ma'am, how are we going to account for this? Day 1, you have made the payment. It is already at present value only. So I will debit bank. How much? 1 lakh. That's what you paid me. I will credit what? Financial liability. How much? 1 lakh. Yes. Going forward, I will have an interest expenditure. So debit, interest expenditure, credit, financial liability. First year, it will be 10,000. Yes, ma'am. Hi, how 10,000? 1 lakh into 10%. Okay. So second year, what will be the closing balance of my financial liability? Can I say? 1 lakh plus 10,000. Can I say 1 lakh 10,000? So again, I will have an interest expenditure for the second year also. So what will be my interest expenditure? Can I say? Interest expenditure, credit, financial liability, 11,000. Yes. So 2 years later, what will be the closing balance of my financial liability, sir? Can I say 1 lakh plus 10,000 plus 11,000? 1,21,000, sir. Yes. And I'm teaching you 2 years later. So the prices of my course will automatically increase by that time. Yes. So on that date, I will de-recognize my financial liability. I will de-recognize my. So I will debit my financial liability, 1,21,000, and the same amount will be credited to my revenue. Okay. Easy. Simple. Yes, sir. Amit, sir, are we okay with this? Please. So whatever I taught you over here, this part is not your IFRS 15. Okay. I take it with IFRS 15, but it is a part of your IFRS 9. All these journal entries are a part of your IFRS 9. Okay. Even this, what we did over here, receivable, interest income, bank and receivable, it is again a part of your IFRS 9. Okay. IFRS 15 is only concerned till this part. And in this case, IFRS 15 is only concerned with this part. Here, IFRS 15 job is done. Whenever you hit P&L in the name of revenue, IFRS 15 is out of picture. Are we okay with this part? Yes. So with this, we complete IFRS significant financing component also. I want you all to note down this chart. This chart is like one simple solution for your this. You'll note down this. Then now we'll solve really good sums. Like really good high level sums will solve. So once you all are done with this, just help me with, just give me a thumbs up and you can just tell me that you're done. Scroll up, scroll down, whatever you want to tell me. Done? Done with this part, sir? Amit, sir? Can I scroll up? Yes, sir. Just give me some confirmation, sir. Yes, okay. Should we do this? Done with this journal entries also? Okay. These also? Done, right? All these journal entries are done. You want to write the example?
No.
Okay. Okay. So we go forward now. We discuss one sum. Interesting sum. Okay. So I'll read what is given in the book. What is given in the book. We'll read that and we will have we'll do some sums. Okay. Okay. Significant financing component. So what did we learn over here? Determining the transaction price must consider the timing of payment, provides if it provides the customer or the entity with the financing benefit. Either I am giving a loan or you are giving a loan to me. So following are the indicators of your financing component. First, the difference between amount of promised consideration and cash selling price of goods and services. That's what we learned over here. Yes, you remember? The first indicator. There's a difference between cash selling price and transaction price. Second indicator is what? Length of time between the transfer of promised goods and services to the customer and payment date. So there is a time gap between the promised goods and services and the payment date. If there is a financing component, sir, then the consideration received needs to be discounted to the present value using the rate at which the customer borrows the money. So if you are giving me if I'm giving you a loan, I will have to discount it using what rate at which you borrow the money. So for example, a coaching institute fees today is what? 30,000. If you pay 1 year later, you will have to pay how much? 36,000. So can I say this is a future value? This is a present value. So extra this 6,000 is basically a interest. So the first, you remember the first example? 13,100, 12,000. So treatment, 30,000 will be my revenue, 6,000 will be my interest expenditure. So if you all have understood, if you both have understood this SFC properly, try this question. I'll read the question for you all. Take 5-10 minutes and tell me how will you recognize this. Ruth enters into a contract with customer to sell equipment on 31st of December 2001. Control of the equipment transfers to the customer on that date. So tell me, control has been transferred on which date? 31st December. Can I say PO is satisfied? Control transferred. I'm selling an equipment, right? So if I sell you equipment today, the control from me to you transfers. So can I say I can recognize the revenue? Yes. The price stated in the contract is 1 million. Can I say 10 lakh? 1 million is nothing but 10 lakh. It is due on when? 31st December 2003. When did I satisfy my performance obligation, sir? 31st December 2001. When is the customer going to pay me? 2 years later. 31st December 2001. So 31st December 2002, 31st December 2003. Market rate available to this particular customer is how much? 10%. Tell me how the transaction should be accounted for in the financial statements of Ruth for the year ended 31st December 2001. Tell me. Try and tell me. Which scenario it is, sir? First or second? First. So I think we know debit, receivable, credit, revenue. It's just the value that you have to find out. You'll have to find out the present value. So what is the present value, sir? 1 million. Can I say 10 lakhs? 10 lakhs. What is the rate? 10%. So how do we find out the present value, sir?
8,26,000.
Perfect. Done. You are right. 1 plus 10% raised to 2. Yes, sir. Amit, sir. Tell me. The value. Yes. 1 point. How much did you get, sir? So you all got this answer? Your 8,26,446. Yes, that's what you got. That's what you got, sir, Amit, sir. Yes, perfect. Amazing. So can I say due to length of time between transfer of control of the asset and the payment date, this includes a significant financing component. So consideration must be adjusted for the financing transaction. The discount rate used that reflect the characteristics of the customer, that is the borrowing rate of the customer. Revenue should be recognized when the performance obligation is satisfied. So as such, revenue will be recognized and the corresponding receivable should be recognized at 8,26,446 at 31st December. The receivable is subsequently accounted for in accordance with IFRS 9. That's what I taught you all. Subsequently, it will be your financing, significant financing component. Are we good? Yes, everybody. Yes, sir. Are we good? How comfortable are you with SFC? So with this, we complete our step number 3 also. Almost 3 hours we took to complete, like 3 hours 30 minutes to complete the 3 steps. But you feel it was good, worth it? Okay. So we quickly revise our first 3 steps. That's the process, because if I complete something, I want to ensure we haven't forgotten the first 2 steps. So step number 1. Okay, first we go with the introduction part. Now that you see your efficiency will increase. We started with the 5-step model. What is the first step? Identify the contract, identify performance obligation, determine the transaction price, allocate the transaction price, recognize revenue. First step, that is your identification of a contract. There are 5 conditions. Your contract should meet all the 5 conditions to say that there is to make IFRS 15 applicable. First one is what? Approved. Second, rights have been identified. Third, payment terms have been identified. Fourth, there is a commercial substance. And fifth is collectibility is probable. Okay, ma'am. If any of these conditions don't meet, IFRS 15 is not applicable. It means what? The credit can never go to revenue. But the standard says, Baba, if you have received some money, even if your conditions don't meet, you can recognize revenue only and only if either of these two situations are there. Now, what are the situations? First situation is what? The consideration is non-refundable. Second, substantial amount of the consideration has been received and performance obligation has been satisfied. No remaining performance obligation. So if this is the situation, please recognize revenue. Second is what? Contract has been terminated and the consideration is non-refundable. In either of these two situations, even if any of those 5 conditions did not meet, you please recognize revenue. Ma'am, what if it doesn't fall in any of these two situations? You will recognize a contract liability. Good with this part? Okay. So this was our step number 1. Step number 2, we have to identify separate performance obligation. And what do you mean by separate performance obligation? Distinct promises made by the entity to the customer. So then how do we say that the performance obligation is distinct or separate? It has to meet both the conditions. First, customer can benefit on its own. The customer can benefit from whatever you are receiving either on its own or with readily available resources. Okay. Second, the performance obligations are separately identifiable. It means they are not interdependent. There is no significant integration. In these two situations, you can say what? Your performance obligation are distinct. There are multiple performance obligations. If either of these two conditions don't meet, then what do we say? There is a single performance obligation. Cool with this part? Okay, step number 3. Step number 3, determination of a transaction price. Now, in determination of transaction price charters, there are 4 things that we had to master. First one was variable consideration. Second, significant financing component. Third, consideration payable to the customer, and non-cash consideration. So when we started off with variable consideration, what did we learn? When do you include a variable consideration in your transaction price? When it is highly probable that significant reversal of revenue will not occur when the uncertainty is resolved. Now there are 2 methods to measure variable consideration. What is what? Estimated value method. Expected value method, and second one is most likely method. When do we use expected value method, sir? When there are multiple outcomes. When do we use most likely method? When there are 2 outcomes, either this or that. Okay, we're okay with variable consideration also. Then we went to our non-cash consideration. Non-cash consideration, what did we learn? Whatever I receive from you is in the form other than cash. It can be shares, asset, anything. So standard says, if you can measure the fair value of what you have received, Surbhi, please go with the fair value of what you have received. If you cannot measure the fair value of what you have received, then second preference, if it is not readily determinable, selling price, standalone selling prices of the goods and services provided. So if I can measure what you have given, fair value, that is my transaction price. If I cannot, then what I've given up is my transaction price. Okay, perfect. We are good with this. Now non-cash consideration is also done. Now we go to the consideration payable to the customer. So if Surbhi is paying, if the entity is paying something to the customer, and it is in return of distinct goods or services, then in that case it is a separate purchase transaction. If it is not in return of any distinct goods or services, then it is what? It is treated as a reduction in the transaction price. Okay. SFC, 2 indicators. Difference in cash selling price and the standalone selling price. Okay. Sorry, transaction price. Now, second one is what? There is a length of time between payment date and performance obligation. So if these are the 2 indicators of your significant financing component. Now I would like to revise this with this chart that we prepared. So can I say when the payment is done, performance obligation is done, payment not done. So here corresponding credit goes to your revenue. Performance obligation done, triggering point has been triggered, you go to revenue. The corresponding debit, since payment is pending, you will debit your receivable. Going forward, you will have interest income in this. In this case, you will take the rate applicable to the customer. Second situation, when the payment is done, but the performance obligation is pending. Here, you cannot credit your revenue. Yes, so you will have to recognize a financial liability, debit bank, credit financial liability, and going forward you will have an interest expenditure. Once you're done satisfying your performance obligation, you will do what? You will de-recognize your financial liability, you will recognize revenue. Okay, okay, perfect. So with this, we are done with the step number 3 also. Now let's try some questions. Shall we try some good questions? Okay, variable. I'll have to teach you this also, I think. Yes, this has variable consideration. Let me read this question. Okay, this is the first one, Bodium, yeah. Okay, and okay, so we discussed this question first, then I'll teach you, to teach you further something new. I'll have to teach you sale with right to return. So this question we can manage without sale with right to return, determining the transaction price. Okay. Now you should assume, the question itself states, you should assume that both the contracts described below meet the requirement of IFRS 15 revenue recognition model. It means all the conditions have been satisfied. Now, Bodium is a manufacturer of consumer goods. Bodium entered into a 1-year contract to sell to a large global chain of retail stores. Okay, so who is the supplier over here, sir? Seller, Bodium. Whatever is the name, Bodium, I think Bodium is a supplier. Who is a purchaser, buyer? Can I say? Large global chain of retail stores. Can I say DMart maybe? We can give an example of DMart. So we can think of this global chain as a DMart. So Bodium is a supplier, DMart is a customer. Now the customer committed to buy at least 30 million of the product over 1 year period of time. Can I say this is my transaction price? Yes. Can I say this is my over a period of time? Performance obligation will be satisfied over a period of time? Yes. So over a period of time. Okay. Now the contract required Bodium to make a payment of non-refundable 3 million to the customer at the inception of the contract. Who made payment to whom? So it is an indicator of what? It looks like what are they going to ask us in the question? Bodium made a payment, non-refundable payment to customer at the inception of 3 million. Tell me, it is which part of our transaction price they are testing us on? I made payment to you, sir, 500 rupees. You will pay me 30 million, sir, but I made a payment of 3 million to you today. So, consideration payable to customer. Yes, are we able to understand or not? Sure, guaranteed. Yes, sir. Are you able to understand? Can I say customer will pay me 30 million? I am making payment. The contract makes me make a payment of 3 million to the customer at the inception of the contract. Okay. No, not okay, sir. Tell me, what are we not okay with, sir? Tell me, what do you want me to explain? Are you okay? Guaranteed. So if I write over here, can I say it is consideration payable to customer? The second part. Sir, let's read the second part, okay? I'll just clear this part. Sir, the question says the customer committed to buy at least 30 million product over 1 year contract. Are we okay with this part? You are my customer. You said, Surbhi, I will buy for the next 1 year. I will buy at least goods worth rupees 30 million from you for 1 year. Are we okay with this part? So who is a supplier, sir? Bodium. Who is a customer? DMart. Okay. First part, okay. Now the second part says the contract, as per the terms of contract, let's say I am Bodium and you are DMart. It requires Bodium, that is, it requires me to make a non-refundable payment of 3 million to the customer at the inception of the contract. So only one case, only at one place, only in one place we learned that when does this happen? When we are talking about consideration payable to the customer. Yes or no? So don't you think they are testing us? 30 million is what Surbhi will receive from DMart and 3 million is what Surbhi has to pay to the DMart. Yes, sir? I did. Understood. So can I say it is nothing but consideration payable to customer? This is a difficult question. I will not let you all solve this. I will myself discuss this question with you all. The 3 million payment is to compensate. You mean, it means what? See, what did we learn in our consideration payable to customer? This 3 million will be treated as a reduction if it is to compensate or if it is a cashback or something like that. If it is in return of some distinct good or services, this 3 million will be recognized as a separate purchase transaction and this will be recognized as my revenue. Yes or no? So it is to compensate, sir. It means what? My total transaction price will be what? 27 million. Are we okay with this part? Yes, it is to compensate the customer for changes required to its shelving to accommodate the Bodium's product. Bodium duly paid 3 million to the customer on 30th of November. So what has happened over here? You are DMart, I am let's say I am Go Cheese. Okay, now I want you to sell my product in your DMart, in your outlets. So you said, Surbhi, I will buy 30 million, but your cheese requires some different types of temperature that I don't have. So I said, okay, whatever changes you want to make in your refrigerator, I will compensate you for that. So you will pay me how much, sir? 30 million. To compensate you for the adjustments that you made in your shelving, can I say I will have to pay you 3 million? Yes. So can I say my price, transaction price should be reduced by 3 million? Reduction in the transaction price. Yeah. Withdraw diagram. Okay. Which cheese do you like, sir? Which is your favorite cheese brand? Amul cheese. Amul doodh. Amul cheese. Okay. Let's say there is a DMart. Okay. Now Amul is a manufacturer of cheese. Amul and DMart enter into a contract wherein DMart will purchase cheese worth rupees how much, sir? I'll use the same numbers. Can I say 30 million over how many? Over what period? One year time. Now DMart has some refrigerator issues. It cannot store the mozzarella cheese. It requires some different kind of temperature. So what did Amul say? I will give you what? 3 million. I will give you what? 3 million to compensate you for the changes that you have to make in your refrigerator. Are we okay with this part? So how much am I going to receive? 3 million. How much am I going to pay? How much am I going to receive? 30 million. How much am I going to pay? 3 million. Are we okay with this part, sir? Yes. Yes, sir. Are we okay? Now the question comes. This 3 million that I paid, that Amul paid to DMart, is it in return of any goods or service? No. Then if it is in return of goods and service, can I say my revenue will be 30 million, my purchases will be 3 million. It is not in return of anything in return, in any goods or services in return. So can I say my transaction price has to be reduced by 3 million? Yes. So can I say, oh, in totality, my transaction price will be 27 million. Are we okay with this part? Yes, sir. Amit, sir, are we okay with this part, sir? Please tell me. Yes. So we now see how are we going to account for this. So you are required. How will you account for this as a payment to the customer? Now tell me, when did I make the payment, sir? 27th of November. Yes. Did Amul purchase anything on this date from me? No. Amul will purchase when? Over 1 year period of time. So if Amul would have purchased something from me, what is the journal entry I would have passed, sir? If let's say, I'll give you first what would have been my journal entry if Amul would have purchased from me. So let's say Amul purchased 30 million goods today from me. So I will debit what? Either bank, if Amul made the payment, or receivable. Credit, revenue, how much? 30 million. Yes. This is the entry I would have passed if Amul would have purchased from me today itself. But my transaction price, but I know my transaction price should be how much? 27 million. My revenue should be recorded at 27 million. So to reverse this, to give the impact of this, can I say I will credit my bank? Why? Because actually the money has gone out. Yes, I will credit bank how much? 3 million, and I will debit my revenue. Why? I will have to reduce my revenue by 3 million. Reduction in transaction price. How much? 3 million. Are you okay with this part? Satisfy yourself with this journal entry. If Amul would have made on day 1, if Amul would have made the payment or would have purchased from me today itself, I would have passed this journal entry. Are we okay with this part? Amit sir, are we okay with this part? Tell me. If not okay, I'll explain again. I don't mind. You should be okay. Yes. You okay? Okay, sir. Amul purchase. Let's say I am who? Sorry, not DMart. Sorry. I know where you got confused. DMart. DMart purchased goods worth rupees 30 million from Amul today. So can I say this is the journal entry Amul will pass today? Credit revenue, because performance obligation has been satisfied. You purchased and I transferred goods to you. And if DMart made the payment, I will debit back. I will credit receivable. Yes. But now I know I also made a payment of 3 million to you. Yes. If it is in return of separate purchase transaction, I mean it's a return of distinct good or service, can I say I would have debited some purchases or some cost? But I can't do that because it is not in return of some goods or service. So the corresponding debit will go to revenue. It is not my expenditure. I will have to reduce my income by that. So can I say my revenue was debited by 30 million once, and my revenue was credited by 30 million first and was debited by 3 million. So can I say net credit goes to P&L of how much? 27 million. Are we okay with this part? This actually was paid by me today. Are we okay with this part? Sure?
Yes.
Guarantee? Not okay.
Okay.
Guaranteed. Is it coming from the heart?
Yes.
Guaranteed. Can I trust you on that?
Yes.
Okay. So the situation, the problem over here is my performance obligation is not satisfied, because Amol is going to purchase from me when 1 year later, I mean over 1 year, but I made the payment today itself. So ma'am, this entry will not be passed. Why ma'am? Because no receivable, no revenue. This entry will also be not passed. So it means what? This will be passed because today itself I made a payment of 3 million to my customer. Yes. So ma'am, corresponding debit goes to where? Ma'am, you just taught us debit your revenue. Debit your revenue. The answer is no, because I have not recognized my revenue yet, sir. If I debit my revenue, what will happen? It will be a wrong entry. My performance obligation is not satisfied. If I would have recognized revenue already, I would have debited my revenue. But here it is not possible. So then what do we do over here? So standard says, Surbhi, till the time you satisfy your performance obligation, park it in some different money. Park it in some different account. So a new account or a different account where you can park is debit your contract asset. Debit your contract asset. Why ma'am? Because your revenue is not yet recognized. Whenever you recognize your revenue, Surbhi, at that point of time, you please transfer some amount from your revenue to your contract asset. Okay. Okay, ma'am. So are you okay with the first entry? Debit contract asset, credit bank. Are you okay with why did we do it? Why did we not debit our revenue? Yes, because we have not recognized revenue yet. Okay. So standard says, please park it in some different account till the time you recognize your revenue. Okay. So let's say a month later, DMart purchases goods worth rupees 4 million from me. What is the total transaction price agreed? 30 million, right? So Amul purchased goods worth rupees, how much? 4 million. So can I say the debit will go to receivable or bank, depending on what type of purchases it is. 4 million. Credit will go to revenue. Why? Because Amul has purchased goods from me. How much? 4 million. Are we okay with this part? Yes. But ma'am, you have parked some money in your contract asset. You will have to reduce your revenue by that, ma'am. So can I say, I will debit my revenue and I will credit my contract asset. By what value, ma'am? So you will have to find out what is the total reduction. What is the percentage of total reduction? What is my total transaction price, sir? 30 million. What is my total reduction? 3 million. So what is the percentage, sir? 3 million is what percentage of 30 million, sir? 10%?
Yes.
Yes, it is a 10%. So standard says reduce your revenue by 10%. So what is 10% of 4 million, sir? If you 10% of 4 is how much, sir? Just give me now. 4. 0.4. So you will debit 0.4, 0.4. So tell me, what is the corresponding credit to your revenue, sir? What is the total credit? Can I say 3.6? 3.6 is my credit to revenue. So this is the journal entry you are going to pass. Ma'am, let's say 1 month later, Amul purchases more 5 million worth rupees goods. So what am I going to do, sir? Again, same entry. Debit receivable. How much? Or bank? Because that's what Amul has to pay me, right? But my revenue will not correspond to that because I have already paid and I will have to reduce my revenue by that. 5 million. The credit goes to revenue. 5 million. Yes. Now, ma'am, I will have to. Now you have parked some money in your contract asset, ma'am. You will have to use that. So I will have to reduce my revenue by how much, sir? And I will credit my contract asset. By what value, sir? 10% of 5 million. Can I say it is what? 0.5 million, 0.5 million. Are we okay with this part? Yes. Easy. So what will be the corresponding credit to my this P&L? Sorry, what will be the total credit to my P&L? Can I say 4.5 million? The amount. Can I say my receivable will be reduced by 10%? 5 million minus 5% is what? Your 0.5. Are we okay with this part? Easy? Sure?
Yes.
Guaranteed. Slight here and there, no? Yeah. Okay. Yes, Amit sir, when I discuss the question with you, it will get better. Else, we'll also figure it out in different ways. Yes, sir. Amit sir, please tell me. Yes, okay. So now tell me, if I combine these two journal entries, can we combine these two journal entries? Combine, mix it. 11th, 12th. So what will be the combined journal entry? Can I say I debit bank, I debit receivable, 5 million. What is the total credit to my P&L? My revenue is debited by 5 million, credited by 0.5 million. So can I say in net, my revenue is credited by 4.5 million. So can I say I credit revenue by 4.5 million? I credit contract asset by 0.5 million. Journal entry tallied? Yes. We discuss this. If still you're not okay, I'll read the answer for you. If still you're not okay, I will see how we can more simplify it. We'll figure it out. Don't worry. You will not go home without mastering this concept. That's my promise to you. Yes, sir. Amit, sir. Now I'll read the solution for you. So, the 3 million compensation payment to the customer is not in exchange of distinct goods and services. That transfers Bodium, as Bodium does not obtain control of any rights of customer shelf. So I'm just compensating you to accommodate my cheese, sir. I'm not getting ownership of your shelves. So I'm not getting anything in return. In this case, can I say I'm not receiving anything in return? So the transaction price, the payment that I made should be treated as what? Reduction from the transaction price. So consequently, as per IFRS 15, the 3 million payment is to be treated as a reduction from the transaction price rather than purchases from supplier. Yes, if I would have received something from you, it would have been a separate purchase transaction. I did not receive anything from you. It is nothing but a reduction in the transaction price. Now the 3 million should not be recorded as a reduction in the transaction price until you recognize the revenue. Yes, because if no revenue is recognized, what will you reduce? Are you getting me? When I recognize revenue, I will reduce my revenue. Till the time I did not recognize my revenue, I cannot reduce the revenue. So, therefore, on 30th of November 2007, the Bodium should treat this 3 million paid as a contract asset. It's just a simple name. Think of it like you're parking it in some different account till the time you recognize your revenue. Within current asset, since within 1 year, you will do the, you will adjust it. So, you will debit your contract asset, you will credit the cash. That's what we did, sir. Yes. We debited our contract asset, we credited our bank. Why not debit to revenue? Because we have not yet recognized revenue. Revenue will be recognized as and when DMart purchases from us, as and when the global chain purchases from us. So that's when we recognize revenue, that's when we debit our revenue. Are we okay with this part? Yes. So this is going to be my journal entry. If you want to write over here, you can write in a simple language. It's called nothing but temporary parking of funds. Temporary parking the money in a different account. Yes. Now, when Bodium recognizes the revenue from sale of goods, the transaction price should be reduced by 10%. We know why? 3 million divided by 30%. This is a total reduction, right? So, of the invoice price. So, assume Bodium transferred goods worth rupees 4 million to the customer during December 2007. Bodium should recognize revenue of 3.6, being 4 million invoiced less 10%. The accounting entry would be as follows. Debit trade receivable or bank, credit revenue 3.6, credit contract asset. That's what we did. I showed you first the two different journal entries, then a combined journal entry. So this is my two different journal entries. Yes, receivable, revenue. If you combine it, can I say my receivable and bank will be debited by 4 million? My revenue, net credit is how much? 3.6 and contract asset 0.4. Yes, easy. Somehow, okay. Now understand. Sir, now I'll try to explain this to you in your own position. Put yourself in that position. You are Amul. Okay, I am DMart. So let's say I promised you, sir, I will buy goods worth rupees 30 million from you over next 1 year period of time. You will be like, okay, perfect, good to go. Now I need some special changes. I need to make some special changes in my shelving. So you said, Surbhi, don't worry. Whatever is your cost, I will reimburse to you. So the cost that is incurred by me is 3 million. Now, are you getting any separate goods or services from me? No. So you know you will get 30 million from me, but you will have to pay me 3 million today. So what is the net amount that you're getting? 27 million from me. So you will have to reduce, your revenue will be reduced by what percentage, sir? 10%? The total transaction price is what, sir? 30 million? Ayyo. 30 million? But you will recognize revenue of 27 million only. So can I say your transaction price is reduced by 10%? Are we okay with this part? Yes. So, sir, the problem here happened, no? You have not yet recognized revenue, but you have made me the payment. I have not yet made any purchases from you, but you made me the payment. So if you did not make the payment to me, if I would have made purchases from you, you would have debited your revenue. You would have debited your bank or receivable. Just 1 minute. I didn't, I paused the recording, but I didn't start the recording. The last part that I discussed has got, I'll see if they can get it from the Zoom meeting. Yes, everybody? Sure? Okay. Should we discuss one more question? You want to write something on this? Do you want to write? No. Can we take 2 minutes, 5 minutes break? A breather for my throat. So we do one thing. The second part of this question, I'll just get my bottle refilled. You all can take for 5 minutes. You all can close your eyes and sit. We start sharp at 6:30. It's 6:25. I'll just refill. The scheduled time is 7:30. But if we take till 7:45 or maybe 7:50, I'll try. If we finish whatever we have planned, then not an issue. But usually just expect at least on Saturdays that we can we like 10-15 minutes here and there it can go. Will you be okay with that, sir? Okay. Just let me know if you'll be okay with this or not okay with this. If not, you can tell me. I'll not extend. Tomorrow you keep one extra. So tomorrow it won't be possible. Tomorrow we have like this lengthy hour. Today we have 6 hours, right? Tomorrow 9 to 4 is there. So tomorrow I'll be like gone if I take 1 more hour extra. Are you getting me? It's like how many hours? 4, 5, 6 only, no? No, 7 hours tomorrow. So tomorrow little bit, please think of me also, sir. If not, okay, then next Saturday we'll do. No compulsory today. If you have plans, I get it, we can have plans. It's only if something is that I wanted to discuss with you, if I am not able to complete, can I just... No worries if we cannot. Okay. So, on 1st July 2007, Bodium, now there's a new contract that I'm talking about. First contract, are we all okay with this? First one, are we okay? Now, Bodium entered into a contract with another customer to sell product A for 200 per unit. Okay. If the customer purchases more than 1000 units of product A in 12-month period, the contract specifies that the price is retrospectively reduced by 180 per unit. So tell me, what is it? What do you think it is? My initial transaction price is what? How much, sir? 200 per unit. So if I purchase more than 1000 units, can I say my price will be 180? So tell me, it's signifying what? Oh wow, you have my heart, all of my heart. Amazing. What do you think it is, sir? Amit sir, what do you think it is? So which method, sir? Can I say most likely?
Yeah, because there's only two.
Yes, either my transaction price will be 200 per unit or it will be 180 per unit. It can't be both. Why it can't be both? Because retrospectively, it means what, I'll have to go back and change. Retrospective and prospective adjustments, you all understand? Retrospective means if you have recognized your revenue at 200, if customer purchases more than 1000 units, you will have to go back and change your transaction price to 180. It means what? You will have to reverse your revenue. Okay. For the quarter ended 30th of September 2007, Bodium sold 75 units to customer A. At that date, Bodium concluded that the purchases would not exceed 1000 unit threshold, and therefore the required volume discount threshold required 1000 unit threshold required for volume discount, and therefore recorded a revenue correctly at 15,000. That is how, what? 200 per unit multiplied by 75. Are we okay with this first part? What has happened? So first quarter, that is 30th of September quarter, what has happened? The customer purchased only 75 units. And in our opinion, we were sure that significant reversal of revenue will not occur because in 1 year's time, the customer will not exceed 1000 threshold. So we recorded a revenue of how much? Can I say 15,000. So what is the journal entry we would have passed, sir, on this date? Help me with the journal. Debit bank or receivable, credit revenue. Yes, 15,000, 15,000. Easy. Okay. Now in October 2007, the customer acquired another company. For the quarter ended 31st December 2007, Bodium sold additional 500 units of product A to the customer. In the light of this, Bodium concluded that the customer's purchase are now highly likely to exceed 1000 unit threshold in 12 months, that is up till 30th of June quarter. Okay, so ma'am, what is happening over here? I will draw a timeline for you all. I'll draw a timeline for you all. We started when, sir? We started in June 2007, right? July 2007. So 1 year ends one. Can I say 1st July 2007 to 30th of June 2008. Are you okay with this part? So in this, we are dividing our revenue recognition in quarter. So what will be my first quarter, sir? Can I September 2007? Then what will be my second quarter, sir? December 2007. Then March 2007. Are we okay with this part? When I am standing on this quarter, September quarter, how much did my customer purchase from me, sir?
75.
75. What is my transaction price? If you purchase more than 1000, I will give you a discount of 20 rupees per unit. So what is my transaction price at this date? What is my assumption? 200. My assumption is what? Customer will not be able to cross that 1000 unit threshold. So I will charge how much? 200. So can I say 75 units into how much? Into $200. So what is the revenue should have been recognized on this date? 15,000. So we pass the journal entry also, debit receivable or bank credit revenue 15,000, 15,000. Are we okay with this part? Now situations change. It's all about the estimation part, sir. We came to this quarter, 31st December quarter. Customer purchased how many new units, sir? 500 units. And we feel, oh my god, the customer will do what? Will purchase 1000. In this period of time, the remaining 6 months that we are left with, customer will definitely cross 1000. So can I say all of my revenue will be at 180, retrospective reduction? So if my estimate has changed in this quarter, can I say my transaction price will also change? Yes. So what will be my new transaction price, sir? Into 180. So for these 500 units, what will be my revenue, sir? What will be my revenue? 80? 90,000? 90,000. Are you okay with this part? Yes? Yes, Amit sir, are you okay till this journal entry, sir? Please help me with this journal entry. I mean, help me if you're okay with this. But ma'am, the contract says it is a retrospective. Retrospectively, the contract price will change. So ma'am, it means what? Here you recognized revenue at 200. You will have to reduce this also. So can I say, what is the extra revenue I recognized? 20 per unit. So I will have to reduce my revenue. First, I'll pass this journal entry. Debit what? Receivable bank 90k, credit revenue 90k. But madam, please reduce your revenue. You cannot recognize, overstate your revenue because now your estimation has changed. So I said, okay sir, I will reduce my revenue. So what will be my journal entry if I want to reduce my revenue? Can I say debit revenue and credit? If the company has paid me, then I will credit back. I will have to refund it back. Or if not, so we assume that company has not paid us anything. We do receivable. Are we okay with this part? What value, sir? Can I say 75 units into 200 minus 180, 20. So what will be the value? Can you help me with this? 75 into 20 gives us how much?
1,500.
1,500. Oh, 1,500. 1,500. Now see, if you carefully see this journal entry, my revenue is once credited with 90,000. Revenue is debited with 1,500. So what is the total credit? What is the net credit to my revenue? 90 minus 1,500. 88,500. My receivable is debited by 90. My receivable is also credited by 1,500. Can I say in net I will have to debit my receivable by 88,500. Yes. So that's all you have to do. So they are asking you, what will be your revenue recognition on 31st of December 2007? Can I say I will debit my receivable 88,500. I will credit my revenue 88,500. Easy. Yes sir. Amit sir, tell me, are you okay with this? Or not okay? Yes. So we read this part. We read the solution. So can I say this is a variable consideration? Yes. Why? Either it can be 200 or 180. Now volume discount incentive, whereby you will receive a discount of 20 per unit. 200 minus 180. If purchases are more than 1,000 units in a 12-month period. This type of variable consideration should be measured by most likely amount. That's what we discussed. Either it will be 200 or it will be 180. Either 200 or it will be 180. Now for the quarter ended 31st December, there has been a significant increase in the demand. We're sitting on this, which quarter, sir? Can I say this quarter? There has been a significant demand. there has been a significant demand, and therefore you concluded that it is highly probable 1000 unit threshold will be purchased and discount incentive will be given, discounted price will be given. So volume discount incentive should be recognized and 500 units should be recorded at a transaction price of 180 per unit. That's what we did, sir. 500 into 180 per unit. However, for the quarter ended 30th of September, you did not expect, so you correctly recorded revenue of 200. That's what we did. You correctly recorded this. But madam, the discount therefore should be applied to these units also for the previous quarter, and you should reduce your revenue by this. Now they have simply explained it. We understood it with journal entry also. Okay. So can I say I will credit my revenue by 500 units into 1800 per unit, and I will debit my revenue by this. So net credit will be how much, sir? 88,500 and 88,500. Easy? Yeah. I just want you to note down this part somewhere, because when you study on your own and you just simply go through this solution, no, you might not be able to understand this. So just draw this timeline. Give heading activity 2. This is what, which activity? Yes, activity 2, part 2. So whenever, give a reference or add a flap also, so that whenever you go through this, I'll share this notes also. It is scribbled only, but I'll share it with you all. I hope it will help. Yeah, activity 2, part 2. And give a flap or some, like something that you can. Amit sir, we good to go? Are you understanding?
Yes.
Amit sir, are we understanding? Yes. Now tell me, after this, what do you all want to study? Difficult one or easy ones? So there's only one difficult part, that is your repurchase agreement. Rest everything is easy. So what do you want? Easy, 2-3 topics, or one difficult topic? Easy. Okay, we go with easy ones. Yeah, I know. You all are like a lot of information, too much for one day. Okay, so we learn all the easy topics. Tomorrow repurchase, then contract modification first half, then we'll start with non-current assets. Good to go?
Yeah.
Okay. Yes. Good to go, sir. Can we go forward? Yes. Okay. So we learn something called as, now we learn 2-3 easy topics. Okay. So we're going to discuss something called as sale with right to return. Now, usually when I teach this, I start with a basic sales entry. A lot of times we're not really okay with what is a basic sales entry. So we start with a basic sales entry. So let's say now here we are going to learn from the perspective of big giants. Okay, think of like Myntra, Amazon. Do you all do online shopping? Yes. Do you like online shopping? Yes. So see, let's say, sir, you purchased a t-shirt maybe from Myntra. The Myntra will give you a buffer period of 30 days or maybe 40 days, whatever it is, I don't know. Can I say within 30 days, if you don't like the product, you can return it back to us. So we understand this, how Myntra is going to account for it. Okay. Yes. Coffee. Huh? That boring?
No. Just a natural reaction.
It's just a natural reaction. So your yawning makes me, conscious. Are you boring Fias sir, right?
Yes.
Yes, sure. Okay, don't worry. Okay, so we understand, ma'am, how Myntra will account for a normal sales entry. Let's say Myntra will purchase from some wholesaler. Let's say you like Levi's t-shirt. Levi's sells t-shirt, right? I'm not sure. Okay, any favorite brand of a t-shirt? Sorry, Otto. What is it? How do you write it? Otto. Okay. So Myntra purchases t-shirts from Otto. So how is Myntra going to account for it? Let's say the date today is 20th of June. 20th of June, Myntra will purchase goods from Otto. Let's say Myntra purchased 1000 t-shirts from Otto for, let's say, we'll keep it 1000, not, we'll keep it 10 only, into $50 per unit. This is my purchase price. Can I say this is my cost also for Myntra? So how is Myntra going to account for it? Myntra will credit back. Why? Because the payment will be made. Or if it is a credit purchases, can I say credit payables? How much, sir? 500. Yes, are we okay with this part? Debit. The debit we learnt in our 11th and 12th. Madam, your school teacher or your college teacher would have taught you debit purchases, credit payable. Yes, that's what we learnt. But the correct accounting should be, you can debit your purchases only and only when you recognize the corresponding sale. So are we selling it right away today? The answer is no. We'll sell it later eventually. So whenever you recognize your sale, then and only then you can recognize the corresponding purchases. So till the time this will be debited to your inventory. That's why we have closing inventory. You see, credit, closing inventory is credited. Closing stock, you remember, trading account, debit opening stock, credit closing stock. So it means what? The stock that we could not sell, the cost was not charged to your trading account. That's the logic. That's the logic. Your credit, it will be credited. So Myntra will debit inventory. Myntra will not directly debit purchases. It will debit purchases only and only when it recognizes a corresponding sale. So tell me, are you okay with this part? Are we okay with this journal entry? Yes. Why I didn't do purchases? Are we okay? Because on the day you recognize your sales, the same day you will recognize your purchases. The P&L should follow the matching concept. If sales have been recognized, the purchases will be recognized. I will have to, actually, sometimes I'll have to go and back undo your basic accounting also. So allow me that buffer. Yes, sir. Tell me, are we okay, Amit sir? Are we okay with this journal entry? Iricha? Yes. Okay. Let's say, ma'am, we go to the 25th or 26th. When's your birthday, sir? Next month is your birthday. Would love to celebrate. I hope it falls somewhere on Saturday or Sunday. When's your birthday, sir? 14th of July. Okay. Do we have Saturday, Sunday on that date? Check. If it's Saturday, Sunday, please do come. We'll celebrate. July is what? Amit sir, what is on 14th July? Amit sir, when is your birthday? Tuesday. Ayo, you'll not be coming to the academy. When is your birthday, Amit sir? November 29. Okay, it's very... We'll meet later. Okay. So on 14th of July, Myntra sold these t-shirts. Can I say definitely it won't sell for 50? It will have its own profit. So Myntra sold these 10 t-shirts for, let's say, $75. Yes. So can I say sold, sale has happened. So Myntra will credit what? Revenue. Yes, revenue of how much, sir? Can I say 10 into $75? 750. Now Myntra will debit what? Receivable or bank or cash, whatever name you like to give, 750. Okay. Now, ma'am, this money that is there, this inventory. Now we will have to de-recognize your inventory because you have sold it. It means the goods have gone out from your godown. Okay, ma'am. So we do what? We credit our inventory. We de-recognize our stock, credit our inventory. By what value, sir? 500. That's the value of my stock. Assume there is no other stock. So 500. Now the debit will go to your purchases. Purchases $500. Now see, my P&L is credited by 750. P&L is debited by 500. Can I say I recognize my GP automatically? The difference between these two is 250. That's my profit percentage. Yes. Are we okay with this part? Now, if I may do little bit of unwinding of our brain, the purchases now have a new fancy name called as COGS, cost of goods sold. So now we no longer say purchases, we call it as what? Cost of goods sold. So tell me, are you okay with this these two journal entries? Any difficulty? Any point? So this is the basic sale entry that any company would pass on sale of on a purchase and a sale of a transaction, goods or services. Of course, not services, goods. Yes. Now imagine giants like Myntra. Now Myntra, when the sale is happening, Myntra is not sure whether all these 10 units will be sold, because there is a probability that some of these units can be returned back. Yes or no? So Myntra is not sure. So let's say on this date, now I want to level up a little bit. We will go with sale with right to return. Myntra has given us a right that you can return back the goods. Yes. So on this date, Myntra presumes, like Myntra estimates, not presumes. Myntra will do the estimation part. Myntra estimates that out of these 10 units sold, 2 units will be returned back. 2 units will be returned back on 14th July itself. So ma'am, it means what? If somebody returns the 2 units, I will have to give the refund back. Yes, here receivable will definitely not come into picture because these are all sold on cash only. You collect the cash only. So can I say Myntra? This is specifically related to Myntra only. Myntra and Amazon only. So can I say it will definitely collect the money back, right? Yes, I mean it will definitely collect the money on the same day itself. So say now Myntra knows that out of these 10 units, I can recognize revenue only for 8 units because 2 units will ultimately come back to me. Yes. So what will Myntra do? Now IFRS 15 says, since Myntra since you can estimate that only 8 units will be sold, in reality, do not recognize revenue for 10 units. So ma'am, it means what? Myntra will credit revenue, but not for 10 units. Purchase return. No, purchase return. It is not a purchase return, no sir. It's a sales return, no sir. How purchase return? Purchase return, when you're returning something, it is a sales return. Myntra is sold and the customer is returning. Are we okay with this? It's not a purchase return. Okay. So Myntra will credit revenue for what, sir? Can I say 8 units into what is my selling price? 75. Help me with the numbers, please. Help me with the numbers. Start at 600. But how much money did Myntra receive on the day one, sir? Full money, right? Full money. Myntra has received how much? Full money. 750. Yes. So Myntra will recognize a new a new accounting, new account I'm introducing you all to. Myntra will credit refund liability. Myntra will credit refund liability. It's a liability, balance sheet item. So Myntra will park this money in a separate account for 2 units into 75. Can I say it will be automatically 150 only? Yes, my journal entry got tallied. So Myntra will park the revenue that it has received in the name of refund liability in some liability. It will show that money that I've received is not my revenue yet. I am parking it in my liability side. It will show it as a liability, current liability. Are we okay with this part? Why are we recognizing as a refund liability? Because if the customer returns back the 2 units, I will have to pay 150 back. Even though I received 750, but I will have to pay 150 back to my customer. Are we good? Okay, ma'am, we're good. But madam, you are contradicting one statement. You said that if I'm recognizing revenue, whenever I'm recognizing revenue, that's when I recognize the purchases also. Here, madam, you are recognizing revenue for 8 units, ma'am. You're recognizing 8 units revenue. But, ma'am, you are recognizing purchases for whole 10 units. That is also wrong. Matching concept. P&L will be disbalanced. P&L will show the income of only 8 units. but it will show the cost of how many units? 10 units. So ma'am, please reverse this entry also. So it means what? Ma'am, you know, right? How did we get this 500? You know, right? We purchased 10 into 50. So the standard says you refund this or reverse this entry also. So what was the entry that we passed, sir? What was the entry? Can I say? We debited COGS, we credited inventory. Yes. So we know we will have to reduce our COGS also. So if my COGS was debited, I have to reduce my COGS. Then what I have to do, sir? Credit COGS. Amazing. So I will credit COGS. By what value, sir? 2 units at the purchase price. My cost is always a cost. No, don't multiply it with 750. So can I say 2 units into, what was the purchase price? 50. 2 units into $50. Yes. So it will come to how much? 100, right? Debit inventory. 100. Do you feel something off about this journal entry? Do you feel something off about this journal entry? Think about it and tell me. No? Do you feel anything is off about this journal entry? Yes, Amit sir, do you feel anything is wrong? Something should not have been done. Okay, I'll scroll the up entries also. I'll show you the whole diagram. You did what? Auto is my purchaser. It's a party from whom I purchased 10 t-shirts for 50. So what is the journal entry recorded? Debit inventory, credit bank and payables. When I sold it for $75, I would have done what? Debit bank 750, credit revenue of 750. Same day, I will record purchases also. Debit COGS 500, credit inventory 500. How 500? This. Yes. Now, I am talking about sale with right to return. I will debit bank because 750 is what I'm going to receive. I will credit revenue only for units that I expect will not be returned back. And I will recognize a refund liability for the units that I expect to be returned back. I am confused. Refund liability. Okay, sir. You are Myntra, sir. Today I paid you 750. But you feel like 2 units I purchased. I'm your customer, sir. I paid you 750 rupees. How did I get 750 rupees? Sir, I purchased 10 t-shirts from you. I paid $75 each. So how much money did you receive in your bank account, sir, today? 750 rupees. Today itself, whenever the Myntra guy comes to deliver, don't you pay the whole 750 rupees? Yes, sir. Do you agree? Myntra's bank account will be debited by 750. Are you okay with this part? Yes. But Myntra is not sure. Myntra is not sure that it can recognize revenue for all 10 units. Because Myntra is still unsure. Sir, you are still unsure that Surbhi will return back at least 2 t-shirts. Surbhi will try, she'll go to the wedding and she'll return it back. That's what a lot of people do. We hide the tag and we go, no, I don't do this, don't worry. He has already started judging me. So what people do, that they'll use it and they will return it back. Yes. So do I have a time to return back? Yes, I have 30 days time to return it back to you. So you say, okay, I know Surbhi so well, and I'm sure out of these 10 t-shirts, Surbhi will at least return me back 2 t-shirts. So you cannot recognize revenue for all the 10 t-shirts because you're sure. Your estimate is so accurate that you will recognize revenue only for 8 t-shirts. So 8 into 75, 600. Good with this part, sir? So it means what? If Surbhi returns back these 2 t-shirts to you, you will have to refund money to Surbhi. Yes, Surbhi will ask for refund. So can I say this is a liability? It's liability on your head. So if Surbhi says, Amit sir, please give my money. I am giving your t-shirt back. Please give me my money back. So can I say you will have to pay 150 rupees back to Surbhi? So you will recognize a refund liability. Okay, sir. It's nothing but a money that you have to pay back to your customer. Okay. Now, it means, ma'am, if my this is a balance sheet item. Bank is a balance sheet item. Yes. This is a balance sheet item. Liability. All the assets and liabilities. Only one P&L item. So it means, ma'am, my P&L is credited only with how many units? 8 units, right? Revenue of 8 units. So it means what, ma'am? If you debit your P&L with whole 10 units, it will be wrong. Matching concept. My P&L revenue is more. Revenue is less. Cost is more. Yes. So standard says, Surbhi, this is wrong. You will have to reverse your cost. The extra cost that you recognized over here, please reverse it. So can I say, if I debited COGS first, I will have to credit my COGS? Yes. So I will credit my COGS. I debited my inventory. Now tell me, what is wrong with this? I'm telling you there's something wrong with this journal entry. What does your heart say? Think about it like a finance professional and tell me. Did I get my t-shirts back? No. This is the day when I'm recognizing the sales entry. Did I get my t-shirt back? No. When will I get? When the customer actually returns it, right? So can I credit my inventory? Do I have it with me right now? So if I have it with me, debit inventory is correct. But do I have it with me right now? No. I will get it when the customer actually returns it. So debit inventory will also go wrong over here. Are you getting it? Because it's not there in my stock. If the auditor comes tomorrow and counts, the auditor says, okay, you recorded inventory of 100, but your inventory is not there. 2 t-shirts are not there. Are you getting me? So here the standard says recognize an asset in the name of right to recover. Logic, is it clear why we cannot debit our inventory? Because we have not yet received the inventory back. So right to recover. So what is a new entry you will pass? Debit, asset, right to recover, credit, COGS. Okay, ma'am. Now I know you have a lot of questions. Ma'am, what if the estimation goes wrong? So we first understand if the estimation goes right. Let's say 20 days later, the customer actually returns the 2 units back to the Myntra. So what will Myntra do? What will Myntra do? The customer will actually return it. So Myntra will debit refund liability. Yes, perfect. Credit bank. Now Myntra will have to actually make the payment of how much? 150, 150. Are we okay with this part? Yes. Now COGS credit was correct only because that's what we did. Now you will de-recognize your this asset. Now we will actually receive your inventory. So can I say now I can debit my inventory? 150, not 150, 100. 100, credit, asset, 100, 100. Are we okay with this part? Yes. So this is when my actually estimation goes right. Yes, sir. Amit sir, are we okay with this part? Tell me. Perfect. Okay. Yes. Now I'll tell you what if more units are returned back? What if less units are returned back? What if no units are returned back? So let's imagine what was my estimation, sir? 2 units will be returned back. What if, ma'am, the customer does not return? It is an estimation only, no? So if the customer does not return, you will reverse the journal entry. So if the customer does not return, it means what? You will debit your refund liability and credit revenue. Now can I recognize my revenue? Yes. 150, 150. Yes. Now if the customer, now I have recognized revenue actually. So can I say I can debit my COGS? Debit COGS what? 100, credit the asset. The whole entry will be reversed back. Okay. Asset, right? This is what you pass the journal entry for the right to recover. Yes, you will have to, now the customer did not return the goods back. So can I say now you will actually have to debit your COGS. You will have to increase your cost and this will be reversed. Now you no longer have a right to recover. It's done and dusted. So you will debit your COGS 100 and you will credit your asset right to recover. Are we okay with this part?
Yes.
Yes. Ma'am, what if more units are returned back? Yes, we estimated 2 units will be returned. What if customer returns how many units? 3 units. Customer returns how many units? 3 units, ma'am. What are we going to do in this case? So tell me. I will have to credit my bank. By what amount, sir? Can I say 3 into 75? It comes to how much? I think 125, right? 225. 225. Yes. This is what I will have to return. I have recorded already a refund liability of what value, sir? A refund liability of how much? 150. So the extra debit will go to revenue. It means what? I will have to reverse my revenue also. Okay, I recorded a revenue of how many units, sir? 8 units. Yes. But ultimately, how many units I was able to sell? Only 7, because 3 units were returned back. So it means what? I had to credit my bank. I had to pay 225 rupees. I cannot say no, right? If you come to me, I will have to pay you. It doesn't matter what my CA has made the estimation. If the customer returns back more than my estimated, I will have to pay back. Yes. So I will credit my bank by how much, sir? 225. I will debit my refund liability by 150, because that's the amount I've recorded. The extra that I returned back is the failure of my estimation. Significant reversal of revenue has occurred over here. Done? Sure?
Reduced the revenue.
Yes, I have reduced my revenue. Are we okay with this part? Yes. So what was the journal entry that I had passed for COGS, sir? We credited our COGS, right? So tell me. Now my inventory will be debited by how many units? Can I say? 3 units. Into what was my cost, sir? 50. So 5 3s are 15. Can I say 150? Yes. I had recorded a corresponding asset with a right to recover of what value? 100, right? Yes. 100. So can I say I will debit asset right to recover? How much? 100. The extra, you're not debit, it's credit, okay? Not debit, credit. The extra credit will go to COGS. It means what the cost, COGS that I recorded extra, even that has to be reversed. 50. So it means what, sir? Here I reversed my revenue of 1 unit. I also reversed the cost of my 1 unit. I know it will take some time to settle it. We'll do the revision part. We'll do the revision. I'll not take anything more. This is the only thing, and I will revise it thoroughly. Okay? Sure? Okay, we do the revision part, then we'll wind up for the day. I know it's very heavy for the first day, but going forward, we'll increase our capacity. Okay. So just do one thing. Before I revise it, you all take 2 minutes of break. Just because if I right away, if I revise it, what will happen? You all will just forget everything. So do one thing. On sale of any goods, this is a basic journal entry a company would pass. But understand, let's say Myntra is selling goods with right to return, sir. If anything happens, if the customer returns back the goods, Myntra will have to return the money. So let's say Myntra estimated that 2 units will be returned back. It means what? Myntra cannot recognize revenue for all the 10 units. Myntra will have to recognize revenue for only how many units? 8 units. 2 units, you will have to pay the refund. So ma'am, but your bank account will be debited by 750 only, because that's what you received today. Revenue will only be for 8 units, because the 2 units will be returned back. So revenue will be only for how many units? 8 units. Credit refund liability. Why refund liability? Because this is the money that I will have to refund back to my customer. Are we good with this part? Easy. This journal entry is okay for us? Yes. But now ma'am, you taught us that your corresponding sales and revenue should be same. Sorry, corresponding sales and purchases should be same. Ma'am, you have credited our P&L only for the revenue of 8 units. It means what? You cannot debit your P&L with purchases of 10 units. So it means what? You will have to reverse your COGS also. So how do I reverse my COGS? Can I say credit COGS? So I will have to reverse this. Credit COGS 2 units into 50. So it means what? The units expected to be returned back multiplied by the cost into, this will give us 100. Ma'am, debit inventory. But that will be wrong, ma'am, because you have not yet received the stock. So the debit to inventory cannot go. So you will recognize an asset in the name of right to recover. Yes, 100. Okay, ma'am, we're okay. So are we okay with this 2 journal entries? Yes, sir. Amit, sir, are we okay with these 2 journal entries? Tell me. Yes.
Second one.
Sorry?
The second one explain.
This one?
Yeah.
Yeah. So, sir, what is the amount of revenue I recognized? 600. It is how? 8 units into 75. So it means what? My P&L is credited by what? How many units of revenue? 8 units. In this entry, my P&L is debited by how many units of revenue? sorry, not revenue, cost 10. So that will be wrong. Imagine your P&L. I'll prepare a P&L for you all. By revenue. How much? 600, right? How? 8 into 75. 2 COGS. 10 into 50. 500. This will be wrong, sir. Why it will be wrong? Because you have credited your revenue, you have recognized revenue only for 8 units, but you are recognizing cost for 10 units. It is overstating of your cost. Matching concept will not be matched. So it means what? The revenue cost of 2 units will be reversed back. So you will credit your COGS. Can I say by COGS? If I do by COGS, 2 into $50. Now my P&L will automatically have a net debit of 8 units only. Yes. So what will be the credit goes to my P&L, sir? What will be the amount I will credit? Can I say 100? So can I say now my P&L will be debited by only cost of how many units? 8 into 50. 5 8 is how much? 400. So can I say 400 will be net debit to my P&L. Are we okay with this part? So we credit our COGS. We credit COGS 100. Why? Because P&L is not P&Ling, right? P&L is not matching. Ideally, the debit should have been to inventory. But even that, this will be wrong. Why wrong? Because inventory will be debited when you actually receive the stock. It's not there in my stock yet. It's my estimate that the customer will give it back to me. So I will not debit my inventory also. I will debit asset, a new asset in the name of right to recover. Because if I have a liability to pay 150 back to you, I have a right to recover my t-shirt back from you. So asset, right to recover with the cost. Okay? Sure? Guaranteed? Okay. So next one, what happens when your estimate goes right? What if your estimate goes right? This is additional, okay? This is a detailed, more detailed. The topic ends over here. The discussion ends over here. The solution will end over here. I am just trying to kill your curiosity. What if this happens? What if that happens? So what if, ma'am, my estimate is correct? My customer actually returns only 2 products. In that case, you will debit your refund liability, you will credit your bank. Simple. This is the amount I parked in my refund liability, I will do this. So now my asset will also be recovered back. So my inventory will grow. I will have actually the t-shirts in my godown back. So I will debit my inventory, 100. I will credit my asset, right to recover. This is nothing but right to recover. Okay with this part? This is when your estimation goes right. Ma'am, what if my estimation goes wrong? My customer does not even return. Customer liked my product. He keeps all the 10 units. So in that case, you will de-recognize your refund liability. You will debit your refund liability. And the money will now be transferred to your revenue. It means what? You will recognize revenue for all the 10 units now. Are we okay with this part? So can I say, I credited my P&L with 600 first. Yes. Now I'm crediting my P&L with 150. You see over here? 150. Can I say net credit goes to 750? 10 into 75. Are we okay with this part? Now, I will debit my COGS 100 again and I will de-recognize my asset. Okay with this part? Now, can I say the asset will be gone from my balance sheet? My P&L will be debited by 100 that I had earlier removed, earlier credited. Now it will be debited if my estimation goes right. So my P&L will be now additionally credited by 150 and P&L will be debited by 100. Can I say the net impact is correct? Are we okay with this part? Sure. So this is when your estimation goes wrong. Okay, ma'am, what if instead of 2, customer returns 3 units? So in that case, you will credit your bank by how much? 225. How? Because now you will have to return 75 into 3. 75 is the selling price multiplied by 3 units. 225 is what you will have to pay to your customer. Refund liability is of how much? 150. And debit revenue of 75. Why, ma'am, 75 revenue? Because you had created a liability only for 150 units. Your customer returned extra 75 to you. So you will debit your revenue by 75. Okay. Good to go. Sure. Likewise, you will have one extra credit to your COGS. You will debit your inventory because now 3 units will be returned back. So 3 units into the cost 150. You will credit your asset 100. Extra credit will go to COGS. Okay. Yeah. Okay, so what I want is last 5 minutes are remaining. You all can just note down this. Tomorrow, the first thing that I'll start with is by revising this only. So you will just write it down. I know it is a little bit heavy for the day. Last part you all will just tomorrow when we revise it with a fresh mind, it will go very smoothly. Just make a note of these journal entries. Then we'll start with our. Then we'll wind up for the day. Don't worry. I'll not give you any more information because I can feel you all are very tired. You did till this point? Done here. No, estimation part. This is extra. If you even if you don't write, it's okay. You understood this part, right? Yes. Even if you don't write the extra part, that's okay. This is just additional knowledge. It'll if you write this, it'll unnecessarily confuse you in your examination. If you understand the logic, tomorrow I'll use this only to revise it again. Okay. Okay, guys. So we'll wind up for the day over here. I feel we don't have any capacity to take more information, do we? I feel so. Okay, sir. So thank you, Amit sir, and thank you, Fayaz sir. Right? Just do one thing. If you are registered for the courses, right? Sir, you are also registered, right? Yes. So do one thing. I'll just open the attendance QR. You all scan the QR. It will guide you how to mark the attendance. Allow me 1 minute. I'll stop the recording.